central banks are not going to go all the way to fight inflation to bring it down to target.
We don't necessarily think the path to a soft landing is completely closed either, but we do think it's getting narrower.
The supply side on inflation is not fixed. The Fed knows that, and they're going to be keeping things tight.
I think you have to take that as a signal that they're willing to do more rather than less.
The biggest concern is that inflation's been around for long enough that it's become entrenched in the labor market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Closed out November with a bang. Hello, December. Live from New York City this morning. Good morning, good morning.
Cash feels great right
For
now.
our audience worldwide on TV and radio, this is Bloomberg Surveillance with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures this morning just about unchanged on the S&P. TK, Chairman Powell, triggering a massive rally in yesterday's session.
You know, Lisa, we're talking before we went live here about the oddities of yesterday. They were sort of down, and there was down, 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 whatever the reasons are, and then boom, up we went. And the real question is, was it a short cover, the people, betting on gloom in the market, saying, oops, I got to get out? Or was it more than that? John, I'm looking at green on the screen. The Dow Jones Industrial Average, 12 months trailing, is a positive 0.31%. Wow.
Big move over the last couple of months. I'd make 2 points. One, it's what he didn't say and what he chose to emphasize. What he didn't say, he did not lean against the easing of financial conditions we've seen over the last month. One. Two, what he chose to emphasize. If you go back to the November news conference, the Fed chair talked about asymmetric risk. He thought the risk of doing too little outweighed the risk of doing too much. He talked about higher terminal rates in our future. And then yesterday, for some reason, he started emphasizing the risk of over-tightening, and that decelerating interest rate increases were the tool to manage that risk. I found that kind of bizarre, the shift in emphasis from the November Fed meeting to what we heard from the Fed chair yesterday.
The market didn't find that odd. They said game on. That
sure,
means that you
great.
didn't push back against us. And guess what? You might be concerned about perhaps creating a real downturn in the economy. He's trying to be nuanced at a moment where the market is not nuanced. He's trying to be nuanced in a market that's looking for him to cut rates and to signal that he is open to that next year. They are going to hear that in even him saying something else. Andrew Hollenhost over at Citigroup completely disagreed with the Dovish interpretation and says that, honestly, this just sets the market up for more volatility in the face of the labor market report that we get tomorrow.
I think it's separate from the Fed. I think it's the earnings guess. Gina Martin-Adams yesterday was great about what is the earnings guess, what is the margin guess, and the backdrop is good nominal GDP, and the story not being reported this morning, which is the opening of China. Renminbi is coming. John, you've mentioned the dollar move. Renminbi is very near a critical strong yuan breakout, which will signal that reopening.
Just a slight easing of curbs in places like Beijing, Bramo, just feeding the enthusiasm of the last month or so. It's not just US equities. We talked about Europe. I think the Euro Stoxx 50 is about 20% off the lows of September.
I didn't know that.
And we got more yesterday with officials out of China moving away from talking about any kind of COVID zero anything. So how much do you end up with a real reopening, especially as they emphasize vaccinated?
I just want to say in the history of Bloomberg surveillance, John, I mean, the way you read in on that, because you weren't watching Powell yesterday, you were watching Messi. John was watching Messi.
I had two screens up, to be honest with you.
I'm sorry.
Once it got through 2 p.m., I started to get pretty annoyed with Chairman Powell. It's like, wrap it up. Let's go.
I actually had
Let's go.
2 screens up, and they were the Mexico, Saudi Arabia, and the Argentina.
I was taking the surveillance naps.
I'm sure you were. Tom slept through Chairman Powell and the football. Futures right now on the S&P are down about 1/10%. Let's whip through the price action quickly. In the bond market, yields on a 10-year down aggressively through the month of November. Down a little bit this morning to 360.16. Euro dollar with a 104 handle. Tom 104.22. Positive a little more than 1/10%.
Yeah, spread comes in negative 75 basis points. There's a little movement off the inversion gloom there, but I'm going to go again to Bloomberg Financial Conditions Index, which is still very accommodative and certainly did not move restrictive on the Powell comments that Hollenhorst brings up.
Just to wrap things up, Bramo crude $80 and about 90 cents this morning.
Yeah, definitely a question mark around the reopening of China, fueling the very unclear picture around oil. Today, what I'm looking for, 8:30 a.m., the data dump includes jobless claims, personal income, and consumption, as well as the PCE deflator. This is the key inflation metric the Fed traditionally has looked at. And what you have seen is actually an increase in core PCE, which isn't exactly what the Fed wants to see. How much does this cause a reversal in some of the enthusiasm we saw yesterday when suddenly the data doesn't necessarily bear out the hope that certain Fed officials have for a soft landing? Today, Fed Speak includes, my God, this is a reality television show. Dallas Fed President Lori Logan, Fed Governor Michelle Bowman, Minneapolis Fed President Neil Kashkari, and Fed Vice Chair for Supervision Michael Barr. I'm actually most interested to hear what Michael Barr has to say about overseeing certain financial institutions, especially after the FTX debacle that was really kind of reinvigorated in terms of the debate with yesterday's discussion with Sam Bankman-Fried. And then also today, France's Emmanuel Macron comes to Washington, D.C. and joins for the first White House state dinner in more than 3 years. Is there some sort of coming together when it comes to trade policy, when it comes to countering inflation that doesn't necessarily hurt other regions? Does this alliance come closer, John?
Lisa, thank you. Looking forward to catching up with Anne-Marie in about 10 minutes' time. Joining us now is Ben Laidler, Global Market Strategist at eToro. Ben, the world is coming towards you. This bullish view, this constructive view. Ben, walk us through the reasons why you think this rally through October, November can continue into December and beyond.
Yeah, I'm a little bit cautious on the pace, but absolutely not on the direction. I do think that the low is in. I think corporates and consumers have been incredibly resilient, and I don't think that resilience is done. And we're seeing both inflation beginning to come down, importantly, the reported numbers, but maybe more importantly, from all those lead inflation indicators, even things like the sort of sticky labor market and housing market, I think are all well off their highs here. We're beginning to get visibility on the top of this Fed cycle over the next few months. Valuations have come down, maybe not quite as much as we would like in the US, but to your earlier point, really dramatically overseas. And that's really where I think the action has been in this big rally off the October low. And when sentiment's this negative, you don't need good news. You just need a little bit less bad news. And I think that's going to keep coming.
I like the green backdrop, Ben. It speaks to your optimism since Christmas of 2018, where you've nailed 3 bull markets in a row. What we see, Ben, is the bears rationalize. That's what they're doing. The excuse is it's one big short cover, but what is there more than just the obvious short cover?
I think we've seen this. The fever is breaking on inflation. We can have a debate about how quickly it's going to come down, but show me a lead inflation indicator which is moving in the wrong direction. At this point, the catalyst for the next bull market is when the Fed actually starts cutting interest rates. For a long way from that, but the necessary step one is they stop hiking, and that I think is the relief that you've been seeing, right now. But again, this is not just about the US. You touched on it earlier. The rally has been dramatically bigger outside the US. The gradual reopening of China, the support to the property sector, the less bad news out of Europe, the peak in inflation in Europe, the lower natural gas prices in Europe, and profit margins are lower there, valuations are lower there. So that, I think, is, unsurprisingly what's been leading this rally. So this is not just about the US. I think this is increasingly global.
How fragile is your view, Ben? If there's a cold winter, let's say, in Europe, does that shift completely your view in terms of how much this rally can continue?
There are plenty of headwinds in Europe. It's going to lead the downturn next year. The sort of strength in the euro doesn't help corporate profitability. Gas prices are probably going to go up again. But those are negatives that we all know. That is why Europe is on 10, 11, 12 times earnings. But corporates incredibly resilient. We've just closed out third quarter earnings. European corporates ex energy grew revenues 20%. It's dramatically more than the US. So we all know the problems in Europe, but I think what we often underestimate is just the buffers that they have there, whether that's the euro, whether that's fiscal policy, how well they've navigated this crisis so far, and how cheap those valuations are. And I think this 20% rally off the bottom is, I think, just a reminder of that, which I think we'd be wise to take on board.
The number one challenge to your call right now is Q1 earnings, or rather Q4 earnings reported in Q1. Ben, this is even from JP Morgan's Marko Kolanovic, who's in line now with Mike Wilson and Morgan Stanley for what they think they're going to see in early 2023. And I'll read you a quote from the team. And Ben, I'd love your response to it. Previous lows in equity markets are likely to be retested. As there may be a significant decline in corporate earnings, we're inclined to think that this market decline could happen between now and the end of the first quarter of 2023. Now, Ben, increasingly, that is overwhelmingly the consensus view. The consensus view is corporate earnings are about to get hammered and this equity market's about to roll over. Ben, what's the argument against that?
well, simplistically, the fact that everyone's talking about it, right? So at least some of it's sort of priced in here. But yeah, point well taken. I think next year is going to be the opposite of this year, right? This year was all about valuations coming down and earnings hanging in there. I think next year is going to be some valuation relief as we get to as inflation comes down and we get to the top of the Fed cycle, but earnings coming under more pressure. So I think you're going to make money in different places. But the surprise so far, which I don't think is done, is how resilient corporate earnings, have been, and how resilient the consumer's been, and how resilient the U.S. economy has been. Fourth quarter U.S. GDP is going to be 3 to 4%. Right, we're re-accelerating here. And why are we re-accelerating? Because inflation's starting to come down and consumers are getting a little bit of that purchasing power back. I don't think we should forget that. If inflation keeps coming down, and in parts of the world like Europe, it could come down even quicker with lower energy prices. So again, I'm not that, we all know that earnings are coming down and they're the weak link. I'm not sure they're going to come down quite as much as people think. And we're going to get some relief from valuation.
Hey, Ben, great to get your perspective. Looking for another move higher here in this equity market and pushing back against some of the gloom. Ben Lader there of eToro. In line, Tom, I've got to say, with what we heard from Neil Dutta of Renmac yesterday on this programme, looking for that re-acceleration in the economy.
It's really important, the distinction between a market economist and a market strategist. Both of them have been dead on in their optimism here. What thunderstruck me there in the comments was EU ex-energy revenue growth of a solid double-digit up, and that goes to the nominal GDP question. Yesterday's economic growth was a 7% plus nominal GDP. It's easy to make money in that if you're profitable.
First back-to-back monthly gains, Lisa, of the year, October and November.
Yeah, we had monthly gains, triple leveraged all cash.
You've been doing well, have you?
Yeah.
I'm talking about the equity market.
Oh, excuse me.
The S&P.
And, you talk about rationalizing with the bears. Can this continue if, we get out of cold weather in Europe or
Should
something
make it
changes?
Marco now on the same page as...
What is that
The
about?
ultimate bull signal. That's basically what people are saying.
We could discuss this morning. Equity futures unchanged from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Federal Reserve Chair Jerome Powell is signaling the central bank will back off its aggressive pace of raising interest rates this month. In a Wednesday speech, Powell also made the case for lowering inflation without sending the economy into a deep recession. Fed policymakers meet for 2 days starting December 13th. The missing billions from the collapse of FTX are still a mystery. The disgraced founder of the crypto exchange, Sam Bankman-Fried, denied he was behind a fraud. Still, he told the New York Times Deal Book Summit he made a lot of mistakes. It was his first major public appearance since FTX imploded November 11th. 3 years since the world's first documented coronavirus patient in China, the country is finally pivoting away from efforts to quash the pandemic. China's COVID czar says the fight has entered a new phase, and the government is making some concessions, such as allowing some low-risk patients to isolate at home instead of in controversial quarantine camps. Key European Union members are looking at a compromise on a Russian oil price cap. Bloomberg's learned they've discussed a $60 a barrel limit to help reach a deal with the EU's wider membership and the broader Group of Seven. The goal is to keep Russian oil flowing to avoid a global price spike while limiting Moscow's revenue. And a standoff between Twitter and Apple appears to be easing. Elon Musk met with CEO Tim Cook at Apple's headquarters. Afterwards, Musk said that Cook told him Apple had never considered removing Twitter from its App Store. Musk began criticizing Apple after the iPhone maker reduced its advertising spending on Twitter. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
Time for moderating the pace of rate increases may come as soon as the December meeting. Given our progress in tightening policy, the timing of that moderation is far less significant than the questions of how much further we will need to raise rates to control inflation.
Chairman Powell opening the door for this equity market to absolutely rip in yesterday's session and close out November with another big monthly gain. From December, live from New York, good morning to you. Here's the price action on the S&P 500 this morning. Equity futures basically unchanged, negative 0.1%. Yields lower through November as we kick off December. Yields unchanged on a 10-year, 359.98. Euro dollar just about reclaiming 104, Tom. 104.29 in the last 24 hours. We get back up up to that level, positive 0.2%.
Jordan Rochester to join later from Nomura. What do you talk to him about? Which pair matters, right now?
What went wrong with some of these FX calls? Because things turned around brutally quick. We went from 103.50 on cable, Tom, end of September through 120 just a couple of months later.
I don't give opinion, but I will say this. I did a lot of technical studies of BBDXY and DXY this morning, and all of a sudden they really have a persistent southedness to them.
Let's just say a lot of people got caught offside with the FX trade in the last couple of months.
They are like one of the BBDXY folks is teach a course. It's so technically wonderful. Also wonderful is Anne-Marie Horton, Bloomberg Washington correspondent. She missed Powell yesterday watching Argentina, which is guess what you'd expect, but she did not miss the rail strike of this nation. It is upon us. It's something from another time and place. Anne-Marie Horton, I'm looking at the Senate, as is the Secretary of Labor. John Ferro will speak to Mr. Walsh here on Friday after the jobs report. Marty Walsh is looking for a path forward. What is the path forward for the Senate?
Well, given the fact that the House cleared this on a bipartisan vote, it does look like the Senate could clear this as well, potentially could clear it as soon as this week. The bigger issue is whether or not this provision on sick leave that the House voted after the legislation. They didn't include in the tentative agreement that they want to make legislation. They voted on it as a provision. And the issue with that is that only 3 Republicans voted for that. So that just sets the tone that that sick leave provision may not get the votes it needs in the Senate, except you have Senator Sanders who's demanding an up or down vote, yay or nay, on sick leave be included, or he will not sign up for that tentative agreement to become legislation. And you also have the likes of individuals like Senator Rubio. You never really see these two on the same side saying that he's for the workers' rights and that he doesn't want to vote for anything that the workers don't agree with. So there is potential for that, but that's where it's going to get tricky.
Why aren't they doing this like if the airlines are on strike or the postal workers on strike? I don't get what's unique about a rail strike versus 10 other critical industries.
Well, it is a good question. We don't normally have these moments where it's down to the wire, in essence, that the strike will happen if this agreement is not in place and Congress does not act. Like you said, Tom, this is something of another era, and this will happen potentially on December 9th. But what the issue have right now is that companies are actually starting to shift things around, not putting them on railroads, because there is concern that this is going to come to a stop, especially when you think of issues like hazardous material that comes from refineries that go on railroads. These kind of materials, these kind of products cannot get stuck, because then you'll have much bigger issues.
In the meantime, President Biden is eating at Fiola Mare in Washington, D.C., sharing a $120 seafood tower with Emmanuel Macron last night. What did they talk about? Do we have any sense of how things are going?
And you can ask John what he thinks about that restaurant.
I will.
I took him there
shortly
once when he visited Washington.
Listen, take me.
Yesterday, Tom, we all know you only go to the Hay Adams. Listen, or Ben's Chili Bowl. Yesterday for
there's no
Macron
difference.
and Biden, it was all smiles when the president tweeted out a photo that he has these friends in town, and it's the dinner before the main dinner, a little bit more of an intimate setting at some place the Bidens like to go to. But obviously, today is going to be this bilateral meeting, and then there's going to be a joint press conference, and trade tensions are the main concern. Emmanuel Macron has called the subsidies that the Inflation Reduction Act will give to clean energy companies, give to EVs. He says it's unfriendly policies, i.e. protectionism. And then you also had his finance minister equating it to what China does. So there's some real friction and tension here. But, Macron will likely say, I'm going to be frank with an ally, and America's oldest ally. That's us. That's France.
What does the U.S. want from Emmanuel Macron? What is President Biden going to be asking for?
I think right now what the Biden administration this is really, we haven't had a state dinner since 2019. So this is really them showing their friendship and olive branch after the AUKUS deal, after obviously his concerns with trade policies. And also, I think for the Biden administration, it's making sure that they are keeping this Western alliance intact, because it's not just the trade issues that you have these growing concerns amongst European capitals, but it's also the oil price cap. That is going to be a big concern on Monday. That has to be in place, or you will not have Russian oil leaving if it's set to be left on a Maltese, Cypriot, or a Greek ship. And there's a lot of concern there, and they also want to make sure that they have France on board with all of these issues as you have this war still raging in Ukraine.
MH, thank you. Great work. I've still got to expense that meal, so I'm not sure why she's
my head's spinning. I'm going to Popeyes around the corner from the Gucci store, and you guys
how did that work out?
It was great. It was nutritious.
You know that when they charge $7 for bread, that you are.
Is that how much the bread was?
Yes, exactly. That's how much the bread was. You might want to check.
MH doesn't eat bread.
Then it must save the bill, I'm sure.
Cheap meal. Just getting the latest from DoorDash. We talked about this briefly yesterday. More cuts coming. They're talking about a reduction of 1,250 positions. The latest headline this morning, Lisa, committed to a reduction in the workforce. Seeing a lot of this through tech, and I think the question we're asking is whether it goes beyond that in the next several months.
Is this the beginning, or is this really a special kind of circumstance with businesses that really built up over the past 10 years, over the past 5 years, in a very different monetary regime at a time when people were willing to get things delivered? Do you both get things delivered as much as you did, say, a year ago?
Sure, yeah. It's getting more expensive, though. I will say
yes,
that.
It's gotten more expensive.
Have you cut back on delivery?
Yes, I have. Yeah.
Okay.
I mean, if I could just take a walk, I justify it as good exercise, and I take a walk. So
no,
it's fine.
I'm so lazy when it comes to that.
All I could say is I'm not really surveying a representative sample size, but I do think that there are some people who are rationalizing how much
I
it
don't
costs.
think asking Tom or I anything about that kind of thing is representative.
No, I don't think it is.
I would agree.
To be honest, particularly Tom.
Look,
Right?
I'm looking at the financial.
over
DoorDash is publicly traded. I'm looking at the financials here. And is it a zombie company? I'm not willing to say that, but all of these companies are stressed across every sector, John. And I'm sorry, it's the great zombie roll-up next year.
We're going to keep having this conversation. DoorDash
Yes.
the latest, but not alone, that's for sure. From New York City, equity futures just about negative, down 0.1%. Massive month of gains again on the S&P in the month of November. Kicking off December with you live. Freya from New York, this is Bloomberg. Live from New York City this morning. Equities up and away over the last couple of months on the S&P 500. Through November, up more than 5%. Through October, up close to 8%. They are big back-to-back monthly gains on the S&P, and the first back-to-back monthly gains we've seen on the S&P of the year so far. Outside of that, looking at futures right now, down about 0.1% as we kick off December. Let's look at the bond market, down 44 basis points on a 10-year. Down 44 basis points on a 10-year in the month of November. This morning, basically unchanged, your 10-year 360.71. I want to finish on foreign exchange just briefly. The dollar index down 5% in November. The biggest monthly decline on the US dollar on a DXY going back to 2010. Tom, it's been a while.
Yeah, there's two indexes. BBDXY is a much better math, the Bloomberg Dollar Index, and the one that we grew up with is the DXY, which is the major trading partners, not including China. They're both elegant, John, but the Bloomberg Dollar Index screams weaker dollar. The people looking for resiliency in the dollar,
Sure.
I need to hear the story right now.
It's caught people offside in a massive way over the last couple of months. I wanted to pick out one single name, Tom, Credit Suisse. My producer Jamie this morning pointed this out as soon as I walked into the building. Credit Suisse is down for a 13th straight session, down for 13 straight days. And we're down, Tom, this morning by another 3%.
We speak to Global Wall Street, and we don't do rumor, we don't do speculation. I got a headline from their chairman, quote, not a surprise that the share price is lower. The question is the why, and I would suggest, I can't even paraphrase it, but the idea that when one thing goes wrong, there's other things to go wrong as well. And right now the thing going wrong is assets out the door at their so-called wealth management platform. And what are those numbers in a week? What are those numbers in a month? And we've gone from 4 Swiss francs. John, we're under 3. 2.73%. Weighted average cost of capital. You can do it on a terminal, folks. 4.5% equity, 95.5% debt. That's the weight.
It's cutting your way to growth is tough. You know that. We saw this with Deutsche Bank. Holding on to clients in an environment like this one is difficult. This is from UBS at the end of November. UBS said that Credit Suisse clients are coming to the bank proactively. They're the kind of things that you start to read. And Tom, to be honest with you, I remember being surprised when we got to single digits on Credit Suisse. 9 handle, 87654, 2 handle in Swiss trading this morning.
Well, in the U.S., and I'm not knowledgeable on the Swiss, but in the U.S., there's all sorts of institutional and prospectus mandates that if you fall below $5 a share, you got problems. You got to sell or, lighten up or whatever, review it at the committee or whatever. But I'm surprised where's the Swiss government on this? I'm surprised that it's not more emergent right now.
The Swiss chairman, the Credit Suisse chairman right now, we've had very few clients leaving. That headline just crossed in, Lisa. I don't know what you make of that, but that headline just crossed on the Bloomberg right now.
They're trying to both bring some capital into the bank and raise capital, which is part of the reason why some people are saying that that's having some issues, which is the reason why you're having the longest streak of losses ever for Credit Suisse, even after all the pain they've been experiencing, while also giving confidence to existing clients that they will exist, that they are just fine. How do you do this? To your point, cutting yourself to growth is a very difficult thing. To your point, Tom, when do regulators step in? When does it become a systemic issue? People are saying no, and pretty much consistently, this is a business that isn't viewed that way anymore. So at what point does it really have the regulatory attention?
Macarena Munoz has it at Bloomberg News. Thank you, Macarena. Kian Abasan, this is at Abosina, at JP Morgan. I'm going to just read it verbatim. Cuts earning estimates by 45% for next year, 33% for 2 years out, and cuts earnings estimates 26% with the James Diamond crystal ball out to 2025. I mean, on the sell side, when JP Morgan talks, people listen. I just want to know how they're getting along day to day with wealth management.
I want to read you the quote from the UBS chairman verbatim as well, Tom, because he was much more diplomatic than maybe that headline would lead you to believe. This is what he said at a conference in London on Wednesday. "We're not actively benefiting at their expense. We view them as a worthy competitor going through a crisis, which I believe they will manage and get to safer ground. But we are also in a world of clients moving money around, Tom, where clients proactively approach us." There's going to be winners and losers. Look, I will say this. We all know some supremely talented people who work at Credit Suisse.
Absolutely.
And I wish them the best of luck, Tom, in the same way that we did with Deutsche Bank.
I was lost in Bahnhofstrasse once. I walked in the front door and the receptionist asked, I said, "Where's the Hermes store?" And they pointed
gave
me
you
down
directions.
The street. Down there.
I'm pleased you got to the important stuff this morning.
That's the important stuff as well. Let's look at the U.S. economy now. What we're going to do is dive into the labor economy of America. We've got claims today and, of course, a critical jobs report tomorrow. Rabila Faruqi joins us now, chief U.S. economist with Carl Weinberg at High Frequency Economics. Rabila, what is the distinction of what we're going to hear Friday, tomorrow at 8:30? What matters to you and Carl?
Good morning. Thanks for having me. What we're really looking at beyond, the usual, headline job numbers and the participation rate, it's wages, right? Chair Powell made it very clear yesterday what they're focusing on in terms of the inflation, dynamics, and that is what we're going to be looking at. We're looking for a very small deceleration, but really very far above where the pre-pandemic trend was, very far above with what the Fed is saying is consistent with the 2% inflation target.
Right.
So, just definitely is going to be something we're focusing on, but not something that we're going to see, imminent improvement on either.
I want to dovetail with the academic zeitgeist that's out there, Rabila, and this is the academics saying maybe the labor participation rate is not accurate because of the pandemic and older people retiring. Is this good math that we see Friday?
I mean, we've seen this adjustment, right? Post-pandemic, where you've seen excess retirement. So we really shouldn't be looking for the participation rate to improve too much. But if you remember, before the pandemic, when the labor market was strong, job growth was strong, but people were coming back into the labor market. So what is the dynamic here? Is growth going to slow enough that people will want to get back into the labor market? Are their savings going to diminish enough? Is the cushion from, the income support that they've had, is that going to dissipate and they are going to be motivated to come back into the labor market? Certainly a possibility, not our base case right now, not the Fed's base case, certainly. If you heard Chair Powell yesterday, that's not what they are expecting to see. So I think those dynamics, that post-pandemic distortion, is probably going to last for some time.
Rabila, you mentioned Fed Chair Jay Powell in his speech yesterday. A lot of people thought that it was more dovish than expected. At least he didn't come out with a hawkish rebut of some of the gains that we've seen in the equity markets. However, to your point, he talked about the labor market tightness and how significant of a concern this is for him. How much do you view that as causing the Fed to raise rates higher than the market is currently pricing in, even after yesterday's rally, even after yesterday's perhaps shift slightly in tone from Jay Powell?
So, what I heard from what he said yesterday is that higher for longer, right? Rates have to rise further. They don't really know how restrictive because they don't really know where that level is. But certainly, we're going to move higher. Our base case is they're going to go 50, then another 50 in the first quarter, top out around 5%. But if the labor market does not start responding, our base case is it is, right? 5 percentage points of rate hikes, we don't see how the economy doesn't respond to that. But if we don't see the type of improvement we need to see, and we don't see sustained easing of wage pressures off of these levels, 4.7% to maybe 3.5-ish, then yes, certainly there's this risk that rates move higher. But I think what markets really need to understand is that the Fed does not want to over-tighten now, because then crash the economy and then come out on the other side and ease rates. So they're going to go gradually. They're going to watch what's happening in response to what they've already done so far. And then they're going to see how long they need to stay there. We think that, they reach peak rate, whatever that rate is, in the first quarter, and then they stay there for the rest of the year, at least, to see that sustained, improvement in inflation from a slightly restrictive policy stance.
People would push back, including Ben Laidler, who says that if you look around, there is disinflation everywhere. Is there any area where that's not true, where you're starting to see inflation starting to reaccelerate?
Well, what we're seeing is inflation readings right now are still not that far off peaks. 7.7 on the CPI, down from 9.1%, quite substantial, but still way above target. For PCE accelerating, we're going to see we expect to see a slight deceleration, but these are not levels that are consistent with, what the Fed wants to see. Yes, there are signs of disinflation, but on the good side, services inflation is still very sticky. What Chair Powell talked about in particular yesterday was that core services ex-housing, and that, has a strong wage component to it. So adjustment in the labor market, rebalancing is necessary so that those wage pressures can come under control, which will give them a little bit more room, to sort of adjust to see where we're going from here.
For a man who said there wasn't space for nuance at the last news conference, I have to say there was a lot of nuance yesterday in a way that I didn't anticipate. Rabila, fantastic, as always. Rabila Faruqi there of High Frequency Economics. Pushing ahead to payrolls on Friday, Lisa, looking for 200K. That is the median estimate in our survey, 200,000. The previous number was 261.
How real are these numbers, right? That was something that you both were talking about earlier, especially given that Jay Powell said that the reason why the participation rate hasn't come back is because of early retirements, that 2 of the 3.5 million job openings are due to people who brought forward their retirements. To me, that's fascinating. And whether we see that actually borne out in the data remains to be seen.
I looked carefully at real wages today, particularly off of Olivier Blanchard's essay in the FT, looking at 3% inflation for the long term. And the bottom line, if you take a presidential moving average, a 4-year moving average, we're getting down to the tension point where the real wages have been negative for a long time. We're not quite there yet, where the pain really clicks in socially, but you see it in the strikes. And John, the strikes in the United Kingdom. Should anyone watching or listening, should they fly to London for the holiday season?
You want me to tell them not to? I'll tell you what I'm doing. I'm going.
You're going?
I'm going, of course.
What about the strikes here? The strikes here, the Royal Mail? Is that what they call it?
Royal Mail, the postal.
Dear, the Royal Mail's here. What do they call the postal?
What are you up to? What's going on?
What, for the holidays?
Yeah.
Nothing. I'm going to tuition.
You're not going away. You're just paying tuition.
Right now, it's like 50-50. We don't know what we're going to do.
All right.
Is
this you crossing London off the list? Are you telling the other half we can't go to London?
This is London crossing Tom off the list after this.
We can't go to London this year because of the strikes.
Yeah.
And Mrs. Keene's like, I didn't know. Yeah. Can you ask Tom? Can you ask John tomorrow?
Can you take the train from London to
You
Paris?
can clip this just for Mrs. Keene.
Yeah.
Don't go, Tom. Don't go. The strikes are going to kill you.
Thank you.
From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Federal Reserve is set to slow the pace of raising interest rates this month. In a speech Wednesday, Fed Chair Jerome Powell signaled the unprecedented run of 4 75 basis point hikes could come to an end at December's policymakers meeting. He also made a case for achieving lower inflation without sending the country into a deep recession. A House committee can now look at 6 years of Donald Trump's tax returns. The Treasury Department has complied with the Supreme Court decision and delivered the documents. The Ways and Means Committee meets today to decide what to do with them. The panel could vote to release them or a summary of their findings to every member of Congress. The average British household is paying a price for Brexit. According to the London School of Economics, the spill from the European Union has added 6% to food bills. A study says that's due to additional business costs by so-called non-tariff barriers in the form of border checks. A new survey says that New York and Singapore are the most expensive cities to live in. The report comes from the Economist Intelligence Unit. Tel Aviv, Hong Kong, and Los Angeles round out the top 5. The survey says the cost of living in the world's largest cities rose more than 8% over the past year. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
A big risk, and probably in 2023 we're going to see many countries in recession. Right now we've got both the U.S. and China showing some signs of weakness in the numbers that are coming out.
It's David Malpass there, the World Bank president, on the latest in the global economy. The latest in global markets looks a little something like this. Equity futures down 0.1% on the S&P 500. Big month of gains for November, helped out by the monster move we saw on the final trading day of November. The S&P 500 up last month by more than 5% after a monthly advance, Tom, in November. We had a monthly advance in October, up 8%. So we've had some big back-to-back monthly gains on the S&P.
And it's the quality of it. I don't want to get into it now, but I just think profit and quality have value now, whatever the factors are. Bloomberg Intelligence with their new study of value and growth. And it comes back to, John, a select group of companies showing profit. And the rest of them, like DoorDash, are like,
sure,
now what do we do?
The debate right now between bulls and bears, not about the Fed speak, comes down to the data, it comes down to the earnings. And I think more critically, it comes down to the earnings that you will see in the first quarter of 2023. Because to see Marko Kolanovic of JP Morgan on board with Mike Wilson and Morgan Stanley.
What's that about?
There we go.
Mike Wilson's scheduled to be with us, right?
Looking forward to catching up with him in about an hour and 10 minutes time, yeah.
Yeah,
There's nobody there.
You can't keep up. Well, it's the entourage. Let's do this right now. This has been hugely anticipated. Leland Miller joins us. He is expert on China with Parchment from Washington and Lee from Oxford and the language study in Taiwan. He is definitive. Leland Miller, the China Beige Book needs to be rewritten, and it's about, quote, China's going to open. What does that exactly mean? When people like John and I and Lisa say China maybe is going to open, what's that mean?
Well, it means a lot of different things to a lot of people right now. In the short term, you're seeing this a response to the government, to the protests against the government. The government is acknowledging protesters' frustration with the draconian aspects of COVID-0 and has been easing and has been changing the language, changing the narrative, and has been signaling that, the days of really being locked down and having your life torn apart, that's over. So a lot more freedom of movement. So from that perspective, people are seeing a move towards reopening. The problem here is the backdrop, and the backdrop is quite scary with rising COVID cases. And you're seeing a weakening global economy, and you're seeing some of the worst China data that we've seen in a long time. So it's not altogether clear how you can get from this stage of reopening to the next stage of reopening without some serious problems along the way. Serious problems.
Before we even get into just some of the problems and whether they really have enough willingness to move away quickly to really upend some of the projections on Wall Street, what's the stealth move like by international businesses away from Chinese factories, especially given all of the uncertainty right now?
Well, it's been building for years. You saw corporates start to rethink their strategies and their supply chains because of geopolitical tensions, then the trade war, then COVID, and then COVID-0 really cemented that they had to have a plan B or a plan C. So this is happening amidst the slowing economy and tensions between the two powers. So you've got a few dynamics that are on top of that are weighing on the economy in addition to just COVID-0.
Well, and this, I wonder how much that is the reason why there is this willingness to move away from some of the stricter COVID policies, not necessarily the protests. We've seen China in the past not necessarily cave to protests or social uprisings. Is this really a response to international business and to the deterioration that you're seeing in the underlying economy, perhaps beyond what they previously saw in the past couple of years?
Yeah, I think it's a combination of several things. Obviously, the government protests are a big factor. They are worried about businesses leaving China to some degree. But I think that right. There has always been hasn't been a game plan for figuring out COVID zero, and I think this just expedited the potential exit.
Leland, I'm going to rip up the script here. I was appalled yesterday by the major Western media's coverage of the death at 96 years old of a previous leader of China who was hauled out of Shanghai as a mayor to take over after Tiananmen Square. Now they've got a new leader codified with the party Congress. How close is his protege Xi to what we saw from Xing?
Well, it's a very different type of leadership. Zhang was the beginning of the institutionalization of the current set of rules, which Xi just broke by taking a third term. So I think Zhang thought that he was solidifying the economy by creating norms, creating institutions, creating rules around the leadership. And Xi thinks in order to fix China or to save China, he needs to break all those rules. So it's quite a contrast.
Leland, what did you make of Xi Jinping at the G20? Were you impressed by his performance there?
Yeah, well, we haven't seen him interact with non-Chinese for a long time, so it was interesting. I think that 2023 is going to be a year of a charm offensive for the Chinese in Europe and other places, trying to push back against what they see is a coalition building against advanced technology, ring fencing, and trade and military aspects of the relationship. So I think China is going to try to turn around some of this in 2023 in terms of being so completely inward looking. But again, they've got a long ways to go. They haven't been on the world stage for several years.
I think we see a little bit of that this morning. Leland, thank you. Leland Miller there of the China Beijberg. We had Xi Jinping sitting down with the European Council President Charles Michel over in Beijing, and this is what Xi said this morning. Solving the Ukraine crisis through political means, Tom, is in the best interest of Europe and the common interest of all countries in Eurasia. It is necessary to avoid escalation and expansion of the crisis. That charm offensive that Leland is talking about, pushing back against that coalition building against China. Let's see if that is a key feature of 2023.
How do you do a charm offensive with the one thing that Republicans and Democrats agree on in Washington?
That's his problem right now, sure.
I mean, I don't know how you project that forward. The Secretary of State has been in Asia. I don't know how you project that forward. It's a huge mystery to me.
If they're able to, if Xi Jinping is somehow able to step into what's going on in Ukraine, that would be a charm offensive that would get people's attention. If they really reversed course in some kind of way and said, you know what, we're going to actually take a harder line with Russia, perhaps that would have more influence. But are they willing to go that far, or is this just simply what it is, which is charm offensive?
I'll defer to Leland Miller. They're going to go back to what they've always done, which is goose state-owned enterprises, goose the export industry, blah, blah, blah. We've all seen it a million times. That's how they get back to 5% real growth.
Well, Lita and I have been talking about this. The tension right now that's interesting to me is not Europe and China. It's actually Europe and the United States over the same issue, state aid and the Inflation Reduction Act. So when you get that meeting of minds between the French leader and the American leader a little bit later today, if there is any tension right now, it's over that. It's over that, and it's going to be interesting, TK, to see how it plays out down in Washington.
Well, and let's be honest here, 104 euro off the gloom that we had 6 weeks ago. I mean, is anyone framing out that Europe gets its act together, that Ukraine gets better, that Mr. Putin slips away in whatever way, and all of a sudden you've got 120 euro? I don't hear a single body talking that.
It's not the winter people feared. Let's be clear about that. I think we had the worst case scenario with Nord Stream shut off, but ultimately they got storage capacity up to the levels they wanted it to be, and they were blessed with a milder winter, let's say. So far, so good. The challenge for Europe is to repeat the act next year. To repeat the act, get storage levels up.
I think
without Nord Stream.
I think the only solution is we need a trip to London here. It's January.
We can't do that. The strikes, TK.
You could do it in January, just not December.
Do it in January. 2 weeks in London. I think it gives us
Future's negative. This is Bloomberg.
Central banks are not going to go all the way to fight inflation to bring it down to target.
We don't necessarily think the path to a soft landing is completely closed either, but we do think it's getting narrower.
The supply side on inflation is not fixed. The Fed knows that, and they're going to be keeping things tight.
I think you have to take that as a signal that they're willing to do more rather than less.
The biggest concern is that inflation's been around for long enough that it's become entrenched in the labor market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Central banks are not going to go all the way to fight inflation to bring it down to target.
We don't necessarily think the path to a soft landing is completely closed either, but we do think it's getting narrower.
The supply side on inflation is not fixed. The Fed knows that, and they're going to be keeping things tight.
I think you have to take that as a signal that they're willing to do more rather than less.
The biggest concern is that inflation's been around for long enough that it's become entrenched in the labor market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Why is Lisa so rude to us in the commercial breaks?
It's just unbelievable.
I don't get it.
People were doing all this weepy tear. We've been together since time began.
I know.
What you people don't understand is when we go to break, we don't even talk to each other. We sit here. It's like,
can we just mark that? Can we take a minute? Yeah. It is our anniversary today.
Congratulations
Thank you.
to two wonderful people.
December 1st, a
Bramo
long
came
time
in and
ago.
Changed our world.
I remember that meeting.
Destroyed it,
lasted
actually.
about 10 seconds. Would you like to do radio with Tom? I said no. And they said, you'll be doing radio with Tom. And I said, okay. And it went from there. And then I think from there, Tom, I think people have spent the last however many years trying to work out whether we actually like each other or not.
I'd include Lisa in this as well. There's and the truth is, folks, we all can't stand each other's guts. I mean, it's the way it is. But within the stresses of this, what we all agreed on and what you and I agreed on right from the start is that the data and the conversation matters and not all the whiz-bang garbage of TV. And we're fighting for that every day.
I'm going to set the record straight. Meeting you changed my life. I love you.
Shut up.
All right. Equity futures look like this on the
What's the
S&P
Dow
500.
I'm crying.
Let's whip through the price action briefly.
34,562 on the Dow.
Unchanged on the S&P. Big back-to-back monthly gains on the S&P 500.
Dow green on
November,
the screen.
October. Is this going to be our domestic?
That's our domestic today.
The S&P up more than 5% in November, in October, up about 8%. And Chairman Powell triggering this one, TK, in a big way.
Yeah, and I don't know what to make of it. I thought Ben Emmons had the smartest note out last night, which is he had three parts of the Powell tone. And John, seriously, you mentioned this that earlier, and that, as Hollenhorst said, okay, what changed? And the answer is, I'm sorry, it was hawkish in a cumulative kind of process to 50 beeps in December. So what did the market hear that I didn't hear from Powell?
There was a shift in the emphasis. And it's also what he didn't say. He didn't lean against the easing of financial conditions, and I think that is really important.
Yeah.
I'd also say he emphasised that he didn't want to over-tighten after implying that on the balance of risk, they were thinking that the biggest risk was doing too little, not doing too much. So, Tom, for me, there was a shift there. It was a subtle one, and somewhat bizarre as well compared to the performance we saw in the news conference of a month or so ago.
My shift is, where is economic growth? And I would suggest everybody, whatever their opinion is, it's surprised in the last 6 months to be more buoyant on a real basis and on a nominal basis than anybody expected. And maybe for the first quarter that continues and the recession stays out there somewhere.
I think one thing we can all agree on, Lisa, is that the data is in the driving seat over the next month or so.
And how much is it the actual data versus the soft data? A viewer was listening to what we were talking about earlier about Jay Powell and talking about how many companies do you know that are actually hiring aggressively or hiring as aggressively as they were 6 months ago? So perhaps we're not going to necessarily get the read-through from the jobless claims that we get at 8:30 a.m. or the personal income consumption and the PCE deflator that we also get at the same time. I am watching that inflation metric, since it is one that the Fed looks at, and it has actually climbed in recent weeks. How much is that going to be the theme? This idea that even if you see the overall top line roll over in the face of energy coming down, the core continues to stay strong and prices continue to go up. Today, we have the reality television show that is Fed members, including Dallas Fed President Lori Logan, Fed Governor Michelle Bowman, Minneapolis Fed President Neil Kashkari, and Fed Vice Chair for Supervision Michael Barr. And today, we also get some word from Washington, D.C., with Emmanuel Macron, the French president, coming to join the White House for the first state dinner in more than 3 years tonight. Last night, he dined with President Biden. John, you were really important. You made a really important point earlier where you said perhaps it's more important to look at, John, what we're seeing with respect to France and the U.S. and the alliance with their approach to China than anything else than China versus the U.S., because that might really indicate the contours of the new transatlantic relationship.
Yeah, just that the state of play between China and the United States is pretty well understood. This new tension around the Inflation Reduction Act and the potential for state aid and the pushback we're seeing from the Europeans, Tom, less understood, I would say, and that's a point of tension over the last month.
It's a point of tension, and you go back to the Australian submarine flap and
Sure.
that. But, you know, I looked at the tourist statistics here and the linkage of these two nations just on travel, tourism, the intermingling of the culture.
And a history of it, too.
Stunning. Stunning.
Let's get to Seb Page.
Yeah.
Let's do that right
You
now.
do that right
CIO
now.
and head of global multi-asset at T. Rowe Price. Seb, in your notes, you say you're selectively contrarian. Can you tell me what that means?
You know, we're still careful at the top level. We're still underweight stocks. I don't think we've reached a buy risk moment. But I do see opportunities to lean in selectively. Small caps, high yield, value stocks as part of a diversified approach. We look ahead 12 to 18 months, and those are the asset classes where we see the valuations have reached an extreme where the recession is basically priced in, and kind of like a deep recession, Jonathan.
So, Paige, your book, Beyond Diversification, folks, I can't say enough about Beyond Diversification is an intelligent discussion of too much or too little in your portfolio. I love what you say about Kool-Aid. What's a Kool-Aid of next year look like? I mean, we're all going to drink the Kool-Aid. We're all going to get on a theme. What's a Kool-Aid we need to avoid next year?
I think right now the Kool-Aid is the gloom and doom. We can call it the Lisa Kool-Aid, but that's the consensus.
There we
go.
Thanks, Sebastian.
Things are not, or the Tang, Tom. But you know, things are not looking good right now. You know, you have high stocks valuations, optimistic earnings expectations, sticky inflation, rising recession risks. We're all talking about 3 potential stages to this bear market: the rate shock, which has been priced in, the growth shock, and we're all worried about earnings. And I'm worried about a potential third stage that could unfold next year, which would be a liquidity shock. So that's the Kool-Aid that we're all drinking. I think beyond that, you've been talking on this show nominal growth and the importance of nominal growth and the resilience of earnings. And Tom, you were just talking about even not only inflation stickiness, but growth stickiness. So I think you don't want to drink the Kool-Aid in the sense that you want to go all in cash and give up on diversification because you've just had a co-drawdown between stocks and bonds. I think you go back to a diversified approach and, again, selectively contrarian. I mean, think about small caps. No one really likes that asset class when you're heading into a recession, right? I like the S&P 600. I know you have debates about the Dow versus, I have debates about the S&P 600 versus the Russell 2. The S&P 600 excludes non-earners. Well, that asset class is basically rock bottom valuation of its 20-year range. It's in like the 13 price-earnings ratio. Yeah. It's basically, the price-earnings ratio looks like 2008. So that's an opportunity for me.
Sebastian, I'm just so busy over here just drinking my really depressing Kool-Aid that I couldn't really wrap my head around the positive things that you said, and I keep focusing on the liquidity shock potential. So where do you see a potential liquidity shock?
So it's all about the rate of change, because if you step back, the liquidity level is still quite high, right? We talk about accumulated savings and so on. Where I get worried is this slow boiling frog problem. You know, you put a frog in water and you crank the temperature up, all of a sudden, like, the frog dies and it just doesn't see it coming. I'm looking at the Bloomberg index of liquidity in the treasuries markets, and it's just cranking up and up and up and up in terms of illiquidity. and it's getting less and less and less liquid. And maybe that's QE, that's the change in liquidity conditions. But that is almost level at a level similar to where it went during COVID. And, you saw what happened with the gilts market in the UK. You don't really know where a liquidity shock can come in. The swap spreads are showing illiquidity. And you have other measures like underrun, off the run. They're showing lower liquidity. This is a risk you don't, just keeps brewing in the background. And it could be the third stage. It would make monetary policy really complicated because the Fed would have to do something to fix the plumbing if the plumbing starts to fail like it did during COVID. So, that's why it's not the time to be all in risk assets. Again, I go back to diversification.
Well, Seb, let me pick up on that theme. You're describing the pan of water. Tell me how I avoid being the frog. You mentioned equities. What about being in treasuries?
We have a cash buffer in our portfolios. We've been short treasuries all year long, and that's kind of been the trade. And now if you listen to surveillance every day like I do, everybody's kind of now going long treasuries, and we're neutral treasuries right now. So we just take away from stocks, have a cash buffer, and guess what, Jonathan? What is the best time in capital markets history? What have been the best times to buy risk assets, especially credit? It's been during liquidity crises. So as long as you have your cash buffer, everybody's excited about the 4 or 5% return you get on cash. That's nice. One of the reasons why we have that cash buffer is just because there's liquidity risk out there. You don't really know where it could come in, but it could create a massive opportunity to deploy that cash quickly. And those are historically just really good times to lean in.
And sometimes those windows don't stay open very long, Tom. We saw that in spring 2020, didn't we?
Yeah, and the answer here is they move and they move fast, and you wonder if that's what we're seeing right now. I mean, even the bulls that we talked to, there's some confirmed bulls out there, John Stolfus and Sebastian and others, but you don't know when you're coming off the bottom. It takes months to figure out, it's a bull market.
Hindsight's a beautiful thing, isn't it?
Yeah, you just don't know it when it's happening.
Sebastian Page at T. Rowe Price, thank you. Also, love the notes from Seb. Do you see that line? Just to prepare us for the interview. I care even less about the World Cup than Lisa.
I'm starting to care.
That in the notes. Basically, don't you dare ask me, Ferro.
Exactly.
Don't you dare.
Please.
And
I'm not
TK,
gonna
don't go there either. Futures unchanged on the S&P, live from New York City. Heard on radio, seen on TV. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Federal Reserve Chair Jerome Powell is signaling the central bank will back off its aggressive pace of raising interest rates this month. In a Wednesday speech, Powell also made the case for lowering inflation without sending the economy into a deep recession. Fed policymakers met for 2 days starting December 13th. The missing billions from the collapse of FTX are still a mystery. The disgraced founder of the crypto exchange, Sam Bankman-Fried, denied he was behind a fraud. Still, he told the New York Times DealBook Summit he made a lot of mistakes. It was his first major public appearance since FTX imploded November 11th. 3 years since the world's first documented coronavirus patient in China, the country is finally pivoting it away from efforts to quash the pandemic. China's COVID czar says the fight has entered a new phase, and the government is making some concessions, such as allowing some low-risk patients to isolate at home instead of in controversial quarantine camps. In South Africa, President Cyril Ramaphosa is considering resigning over an advisory panel's report that he may have violated the Constitution. Bloomberg's learned that Ramaphosa is in meetings with allies looking for advice. The controversy has to do with a robbery at the president's game farm. And a standoff between Twitter and Apple appears to be easing. Elon Musk met with CEO Tim Cook at Apple's headquarters. Afterwards, Musk said Cook told him Apple had never considered removing Twitter from its App Store. Musk began criticizing Apple after the iPhone maker reduced its advertising spending on Twitter. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
For starters, we need to raise interest rates to a level that is sufficiently restrictive to return inflation to 2%. There's considerable uncertainty about what rate will be sufficient, although there's no doubt that we've made substantial progress, raising our target range for the federal funds rate by 375 basis points since March.
They've done a lot in about 8 months. That was Jay Powell, the Federal Reserve Chair. The next stop for this big debate is going to be a little bit later this week. It's tomorrow morning. It's Payrolls Friday, just around the corner. Equities look like this on the S&P 500, trying to add to the gains of the month of November. Big gains too, up around about 5% on the S&P. We're just about negative on futures now, down by 0.06%. Yields lower by a couple of basis points, adding to the move lower through November of more than 40 basis points on a 10-year. Tom, your 10-year yield right now, 358.70.
December 1, we dashed to New Year's Eve. Are we going to see an SPX, Standard & Poor's 500, negative 11% right now? Go green?
If you can tell me what CPI will be, where payrolls will
I agree.
fall,
CPI is more important.
then I might be able to give you a better guess.
I agree. I agree. CPI is really critical there as well. I noticed the VIX did not move yesterday. A 19 print in the VIX would be a big deal. We're not there. 20.82 on the SPX volatility. Right now in Washington, Anne-Marie Horton joins us, Bloomberg Washington correspondent. Anne-Marie, Valliere this morning, Greg Valliere with a real sharp note on the shock. Congress wants to spend more than the president on defense. We're getting out very $1 trillion-y on defense, but what I love is the international feel here. United States, these are squishy numbers, folks, don't quote me. $850 billion is the estimate. The next one is China, it's sort of $250 billion. Russia, $160 billion as well. Is the Pentagon the defense of the free world? I mean, are we so dominant that the defense budget that we talk about in Washington is a defense budget of, let's call it, the free world?
Yeah, it's massive, and it eclipses all of our allies and and United States adversaries. I mean, and it has been this way for years. What is stunning about the reporting that Bloomberg government has is that this would be $45 billion more than the president is even asking. So you're getting 11 naval ships instead of 8 that the Pentagon actually asked. And we don't know. There's still negotiations happening, but potentially this Friday we actually will see it, and we will get more details on what's in that. We do know that the president is asking for upwards of $38 billion going to Ukraine. Potentially that could be a sticking point with some Republicans in the new Congress that really just want some more oversight on that money. Yeah. And then, of course, there's also, we're reporting $10 billion more for defense directly to Taiwan. So you're looking at potentially more ships in the South China Sea.
Is there any talk when you're at the restaurant that Mr. Macron was at with the president last night? You're sitting around having $40 martinis. Is there any talk about a military industrial complex?
Well, Tom, I think what you're looking at now is just the defense spending with the Pentagon is shoring up like what the U.S. has in terms of their defense in the United States and all their military bases around the world, which is why you would likely see this welcomed by individuals like President Macron, individuals like Australia's leader, obviously Japan, South Korea, Germany, etc.
Anne-Marie, as we focus on the international, the domestic very much at the forefront with the number of bills that have to get passed, having to do with taxes, et cetera. Little talked about this morning was the fact that Janet Yellen removed her talk about what she thought about Twitter and some kind of CFIUS review of Elon Musk's taking over, even as we see a real crackdown over in Europe. What's the latest on that? Is there some sort of investigation in progress that we're aware of?
There's no investigation at this moment, though CFIUS is potentially looking into it. But this is something that Janet Yellen, this remark was really walking back an interview she gave at CBS at the G20 in Bali, where she said she didn't understand the president's comments on what they would need to be looking at in terms of Twitter and the foreign money they had when Elon Musk took over the company. She said that she misspoke and potentially CFIUS would need to look into this. So it's kind of a murky situation right now because you do have the Treasury Secretary backpedaling, but is that also because she wanted to make sure she was in line with her boss, the president?
Well, and I wonder how much this is an international concern as well, especially with Emmanuel Macron currently in Washington, D.C., and you see the European regulators cracking down. How important is it from a U.S. standpoint to play ball with them from any kind of review that can be done domestically?
I think it is important. I mean, the Europeans are really out front when it comes to this. Just this morning, I was looking at a ban they want on Russian propagandists. You're looking at the way they potentially want to fire people. That's not how it happens in Europe. So you see Elon Musk having a lot of issues with European regulators. Potentially, the United States is maybe on a slower track, but that's the direction of travel. CFIUS potentially may have to look at this with a harder look. And you're also hearing calls from Congress for them to do that.
AMH, good to catch up with you. As always, Anne-Marie down in DC on the latest. This spat between Elon Musk and pretty much everyone. Apparently the spat between Elon Musk and Apple, the potential spat, that's been dealt with, right?
Wait, there was a video after he
met with Tim Cook.
And now he's saying that it was never discussed, that there was going to be some sort of removal from the App Store. Kumbaya. I wonder what happened behind closed doors if he basically was told, look, you keep it up, we're going to pull all of our advertising spending, and that's it.
Tom, you love this story, don't you?
I'm not really following it. I will say this. There's more garbage in my Twitter feed. That is
spam.
A fact. Spam.
I'm getting a lot of crypto spam as well.
Yeah, I'm getting a lot of spam. That's new about 2 weeks ago.
Still waiting to see what he's going to do with the platform. It's his platform now. We'll see what he does with it.
I'm just going to can you get the surveillance cork and put it in my mouth?
Well, what are you about to say that you're worried about?
You're trying to get him into trouble?
No, I'm just intrigued.
It's sort of like Sam Bankman. What's this? Sam Bankman?
I mean, that's a different issue.
Yeah, but
that's a different issue.
It's this enthusiasm we have for real or not real billionaires. I mean, I don't know. It's been a long week.
Okay, can I actually
They were
disagree.
applauding
I think
this
that
guy yesterday?
Okay, but aside from SBF, just with the Elon Musk and the Twitter, there is a real discussion over what free speech means. And there is a huge divide over that. And he's trying to cater to one view of free speech. And European regulators are saying absolutely not. I mean, his removal of some of the guardrails around misinformation around COVID recently, his removal around some of the people who are supposed to police, child pornography and all sorts of things that are absolutely horrific. How do you then dovetail that into some sort of policy? I think is going to be an interesting question.
I'm pleased you brought up that round of applause yesterday with SBF.
Oh, don't get me going.
Utterly ridiculous.
Don't get me going.
And there's two ways of looking at that story. One is this billionaire that lost all his money. Great. The other is someone who potentially committed fraud. And I think a lot of people are uncomfortable with the treatment being around the former and perhaps not so much of the latter. And this bizarre, I had a bad month, ha, ha, ha.
I stood in a bar on First Avenue the night of the Madoff scandal broke with a woman whose parents lost everything with that guy.
Can you imagine,
this is
Madoff at a conference?
All this talk about
Hawaii,
people, all these fancy people in crypto, what about the zillions of people that have broken even or lost money in
Lost
Bitcoin?
life savings.
The lecture is over.
Coming off the back of the biggest one-day rally on the S&P 500 and the Nasdaq since November 10th. You'll remember November 10th because that was the CPI report, and we had a monster move that day. November delivering gains of about 5% on the S&P 500. Futures this December morning down not even 0.1%. On the Nasdaq 100, we're down by 0.11 percentage point. Outside of that, in the bond market, yields lower through November by more than 40 basis points. You can add two more to that. We're down about 2 basis points on a 10-year this morning to 358.88 on a 2-year, basically unchanged at 431.81. A theme of November. Deep curve inversion. We'll pick up on that in just a moment. A theme of November also, a weaker dollar, much weaker dollar through last month. The DXY, Tom, you can pick out the Bloomberg dollar index if you like as well. Biggest monthly loss going back to 2010.
For a lot of people, John, the dollar is underplayed by the equity market shock. People are sort of reeling from, I guess, another bull market off the June rally as well. And there's people talking about going through 200-day moving average. I'm not a big believer in that. But in the dollar, there's becoming some technical veracity that wasn't there 2 or 3 weeks ago. It wasn't there at the beginning of November where you say, is this a trend towards weaker dollar? That discussion is a December discussion.
You know what happens when everyone's on the wrong side of the boat, Tom, and people start running to the other side very
that
quickly?
Always
things
happens.
Shake up. We saw that in foreign
Quickly
exchange
is
in
the
a monster
operative
way.
word there.
Jordan Rochester of Nomura caught somewhat offside with some of his calls as well. We're going to catch up with him, Lisa, a little bit later this morning.
And how much do people get caught off sides when all of a sudden you start to see natural gas prices ticking up in Europe, which you have over the past couple of trading sessions, and a little bit more colder weather? We can discuss that as well with Jordan Rochester. Just want to give you a couple names that I'm looking at this morning. Software shares. people were trying to hide out in software companies, saying that a lot of big businesses were going to continue investing. They are not, as much as people had expected. You're seeing that in Snowflake and Salesforce, with both reporting worse than expected expectations. I find that really interesting because this had been one area that people thought was a lesser bad than perhaps some of the other big tech names. Snowflake shares down nearly 6%, Salesforce down 7.4%. You almost named your dog there. Snowflake. I think that you would have a good, Snowflake. Credit Suisse shares also, we were talking about that earlier, down today in pre-market trading by more than 6% after 13 straight days of losing, the longest streak ever. Those shares are down more than 66% so far.
Wasn't Snowy Tintin's dog? Do you remember that cartoon, Tintin? Did you ever watch that?
That's a European thing.
Was that a Euro thing?
It was a Euro
Was that you didn't get into that?
Yeah, I did get it.
Okay, all right. Move on then.
It's like, that's it. Is that the stock report
That's
here?
it. We're done.
We're done?
You want me to keep going?
No, it's just 4,100 in stocks. I think this is the story of December 1. The shock, and nobody believes in this.
I was confused by Chairman Powell yesterday. Some people might have liked what they heard in November at the news conference. Some people might have liked what they heard yesterday. For me, it wasn't that consistent. There was this odd, subtle shift. And I always think as a central banker, your power lies within what you choose to emphasize. What he chose to emphasize in the news conference in November was this asymmetric risk. And the idea was pretty clear because you see it in the minutes. This risk, that the risk of doing too little outweighs the risk of doing too much. He also said in the news conference that if they do over-tighten, they can correct that by cutting interest rates. Then yesterday, he emphasizes the need not to over-tighten. I'm just wondering where all that comes from.
I'll tell you where it comes from. He's reading Marco.
You think he's reading Marco Klanovich at JP Morgan and thinking what?
I think everybody's heads are tumbling in all this stuff, and they're done. They're ex post. They're after the fact.
Tom, when I notice a shift, something's gone wrong with the communication of this Fed chair at some point between November and I can't work out whether the mistake was yesterday or the mistake was November. To lean that aggressively against easing financial conditions in the news conference and then not even go there at all yesterday is slightly bizarre. I know there's always a risk of over-reading, reading too much into this, but I found yesterday weird.
John, I'm glad over at Good Morning America, they've got the zeitgeist on Ferro, Abramowicz, and Keene. They're saying here, the headline is Bankman-Fried says Madoff comparisons aren't accurate. And I think he's got a point there. These are two different kinds of events we're talking about. We were talking about Mr. Madoff's scandal 10 minutes ago, and to be clear, I agree with Bankman-Fried. They're not comparative, but the shock and the social shock maybe is.
We'll let the lawyers decide that.
Yeah.
We'll let the judge decide that if this ever goes to court.
We're not going to decide it.
I'm not going to have any
Why
influence
isn't he
over
coming
that.
on Bankman-Fried? Come on with us.
No, my issue is exactly that. This is a really serious story.
I agree.
think the approach by the media, and this has nothing to do with the potential case, but the approach by the media, I think has trivialized something really, really serious. And to your point, this obsession with wealth, someone's gone from $1 billion to 100K, and that's the story. That's not the story. The story is that someone's lost their life savings on some of these platforms, and we've got to work out what went wrong.
The only thing we know for certain is Bradley Rogoff wants to say so far from this conversation.
Without a doubt. And he will.
And he's here. Bradley Rogoff is head of FICC FIC research at Barclays, and they launched their important report today. And we do it, and I love Bradley. Thank you so much for joining us. I love what you've got in there about the humility Barclays has about 2022. And you talk about you need a good defense next year. No one breathing is weather the bond reality of this year. How do you recalibrate into next year with a 10% plus loss?
Yeah, obviously it's not what anyone wanted in terms of returns this year, but now you look today, yields are pretty good, right? And it doesn't mean you're going to get 10% plus returns, but the prospect for at least mid-single digit returns, and in some upside cases or in certain markets, even into high single digits, that exists. And it's the first time where it feels like, okay, just based on the yields coming into the year, we don't need a miracle for that to happen. Now, I don't think it's going to be a straight path between here and there, but I think there's a real possibility for that.
So to go ancient, is this a year forward where we're going to clip the coupon, make the yield, or can you say it is a total return 2023?
I think that, clip the coupon, everyone likes to make that projection at the beginning of a year. If you look historically and how often that actually happens, it is quite rare, right? There's usually some kind of vol event. So what I think most likely happens is it's a year where it's not about rates. right? There's some movement, of course, in rates, but nothing like what we saw in 2022. And instead, what happens is we see some spread weakness probably earlier in the year, if the base case of a recession materializes, and then we get really good returns as we get into the back half of the year, and you can start to see some spread compression, back down towards more normal levels.
Do we just avoid a default cycle akin to what we've seen traditionally?
So I don't think we avoid a default cycle, but akin to what we see traditionally. I'll take that second part of what you just said. I think that might be the case. And one of the reasons that's the case, just for the viewers, you'd be thinking about like 10% high yield defaults as a normal recession period default cycle. I think the number probably could be like half of that. And the reason, and a big part of the reason why, is because of 2020. 2020 wasn't very long ago. And a lot of the worst stuff in the market was cleansed out in 2020 with defaults.
This is the irony of this moment. So many people said for the past decade, there is no way that rates could go above 3% just because of how much debt was in the economy, just because of all of the debt piled on companies' balance sheets. And here we are, and rates are climbing toward that 5% level, and people are saying it's not a big deal because there aren't maturities coming due. When does it become a big deal? When does the refinancing cycle matter?
Yeah, I think you'd have to really say at least 3 years from now. I mean, the amount of debt coming due in the next 2 years, and it differs by different markets, but it's going to be less than a quarter of debt for almost every market. If you think about investment grade companies, especially, one of the big stories and one of the reasons we had all the losses that we just talked about last year, the duration of that market went up a ton, meaning they issued a lot of 30-year type bonds. And as a result of that, there's less coming due in the near term. And even high yield, those companies are prudent. They don't want debt coming due in the next 2 years because they don't know when they might not be able to refinance. The one exception, I will say, is, look, there is floating rate debt. And that's the case in the leveraged loan market, and it's going to hit home there a little bit earlier than other markets.
A lot of people, because they couldn't get that yield, they couldn't depend on any kind of massive return, went to private markets over the past couple of years and frankly over the past decade. That hasn't been fully repriced. A lot of people have talked about the pain that is yet to be experienced in that area. When it does reprice, how much of a bleed through could there be in public credit?
Yeah, I think it takes time also because the only way it really reprices is kind of a default cycle, right? If it's a non-mark-to-market instrument. The other thing you would say is, okay, well, what if there's built-in leverage there? Right. And so, for example, something like a BDC does have built-in leverage. They have the ability to put a turn of leverage on those facilities. However, it's a turn, right? And so you're not going to see enough price action, I think, for that to really be the case in 2023. I think the more of the story is those flows that you just mentioned that have been going into private credit, I think those slow substantially. And we're already seeing a little bit of that. And part of it is also that if all of your other investments are down 15% and that one's not been marked down, now everyone looks like they're overweight private credit. And whether you like it or not, you probably don't want to get more overweight.
But I've got to squeeze this in. What did you make of Chairman Powell? Yesterday?
Yeah, I just heard what you made of him. I agree mostly with what you said, but I think part of the reason he came off that way is they are trying to stay a little bit true to the data dependence. And we got another number tomorrow, right? We're going to have, obviously CPI numbers coming up this month. I forget if it was December already. And
next week.
Yeah. And look, I think we all expected it was going to be 50 basis points in December. And we got that. And then I don't know that they know what it's going to be early next year.
Do you think the reluctance to lean against easing financial conditions yesterday is making their job harder?
Maybe a little bit, because I agree with what you were saying earlier in terms of consistency of message, right? And then only kind of change that message when you have conviction in it, right? But I think you saw someone who actually wants to see if inflation is coming down, because we had a print that said yes, but it was one, and we had one this summer that said yes, and then we didn't have them.
And just to be precise, December 13th, so we're 2 weeks away, there and thereabouts, from the next CPI print, Tom.
I think it's bigger.
Just around the corner.
Jobs day tomorrow is a big deal, but the CPI numbers.
He put emphasis on the labour market as well, and wages in a much, much bigger way. Another reason yesterday was bizarre is that he said in the news conference that there wasn't space for nuance around inflation, and then he started chopping up CPI in 7 different ways. It was weird yesterday.
We haven't seen massive dissent on the Fed committee. Is he representing massive dissent and trying to piece it together with perhaps a bit of a muddied message?
Well, yesterday he was meant to be speaking for himself, and at the news conference he was meant to be speaking on behalf of the committee. But I was speaking to people yesterday who were trying to work out whether the news conference was him going off the rails and that yesterday was for the committee. I mean, honestly, I found yesterday really confusing. It didn't make sense. It didn't add up. It was totally inconsistent from the news conference delivery.
We should bring in a psychologist and a meteorologist, and we'll figure it all out.
Well, for therapy for me.
Okay.
Futures, upper 10th on the S&P.
That's what we need. We need joint therapy.
Would you like to come to couples therapy?
That? Couples therapy?
I think we should do that, Tom.
Dr. Abramowicz
Abramo's going to skip that meeting.
I'm going to go watch the World Cup.
We are so vulnerable.
Jordan Rochester of Nomura coming right up. Brad, thank you. It's good to see you.
Brad, thank you.
From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Federal Reserve is set to slow the pace of raising interest rates this month. In his speech on Wednesday, Fed Chair Jerome Powell signaled the unprecedented run of 475 basis point hikes could come to an end at December's policymakers meeting. He also made a case for achieving lower inflation without sending the country into a deep recession. Well, it's now up to the Senate to avert a crippling U.S. freight rail strike. The House has passed legislation that would impose a labor agreement hammered out by rail companies, unions, and the Biden administration. 4 of 12 unions have rejected the deal. The Senate could vote on the House legislation this week. One of the European Union's top officials has warned Elon Musk to keep Russian propaganda off Twitter. EC Vice President Yera Yurova told Bloomberg that failing to take on fake or misleading content online could lead to a very quick abuse of Twitter. It's the latest warning shot over the possible side effects of mass resignations and layoffs at Twitter. And it's one of the biggest casino deals in the U.S. this year. According to the Wall Street Journal, Blackstone has agreed to sell its 49.9% stake in 2 Las Vegas casinos to Vici Properties, which owns a majority stake. Now, the deal values MGM Grand and the Mandalay Bay at $5.5 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
The Fed is trying to run a more aggressive policy relative to its central bank peers, and yet the dollar is going down because there's enthusiasm that, people in Europe won't freeze to death and that China is maybe reopening, and so that's providing some optimism around the global economy. The dollar's coming down, and guess what? The trade deficit's been narrowing.
Neil Dutta was absolutely brilliant yesterday from RenMac. Got a ton of feedback. Thank you for everyone that listened to that. It's available online on Bloomberg.com and, of course, on the Bloomberg terminal on YouTube as well, Tom. Mm-hmm. You're very fired up about that.
Fired up about YouTube.
About YouTube.
It's building.
Okay.
We got a killer audience out there.
I want to get to FX briefly. The turnaround we've seen in foreign exchange over the last couple of months. So let's take the pound against the US dollar, known in FX markets as cable, the low of the year, 103.50 intraday. Got to go back to the 26th of September for that. This morning, Tom, high at a session, 122. We've gone from 103.50 intraday to 122 in just a couple of months.
2 cups of coffee.
Brutal. Euro dollar, you can pick up another currency pair. Euro dollar, low of the year, September 28th, 95.36. This morning, the high of the session, 104.64. These are big, big moves.
What we're going to do is dive into this with Jordan Rochester, G10 FX strategist. I'm going to ask one question here on how do you not lose money, and then John's going to pick it up on the currency dynamics he just mentioned. Jordan Rochester, you, like every adult out there, uses a thing like stop losses. You've been enjoying being stopped out of trades right now. Explain to our audience why it's amateur hour if you don't have stops.
Well, I don't enjoy being stopped out, Tom, but they're absolutely essential to your risk management. I think with the FTX scandal, I think Alameda bragged that they didn't have stop losses, so that's quite clear what can happen if you don't. But look, what's happening in the markets, Tom, how to avoid losing money here, is the market's looking at U.S. energy prices. They've cooled off year on year. That leads PPI, producer prices, lower. That leads headline inflation with a lag lower. So it's quite hard to see reasons why the Fed would get suddenly more hawkish, especially after Chair Powell's speech last night signaling that slowdown to 50 basis points. So you had a green light from the Fed chair last night to sell the dollar and buy risk appetite. And that's why you've seen the NASDAQ up over 4% yesterday. In FX, Tom, the correlations between foreign exchange and interest rates have really dropped off a cliff. The most predominant factor that's driving everything right now is where global equities are going. So I'm currently long euro dollar. We do have a stop on that around 101, 101.70, but I think that's going to go towards 108. I think that's going to be something that could go towards 110 in the new year because of what's happening in China, because the low energy prices we've seen over recent weeks in Europe as well, helping boost European production. So that risk-on sentiment that you see in equities feeds directly to the dollar. Now, there's that famous Spider-Man meme on Twitter where everyone points at each other, blaming each other. FX guys like myself
surveillance. We call that, Jordan, surveillance.
Surveillance. Yeah. FX guys say it's equities driving everything. Equity guys say it's FX. Well, the main point I would say is if you think that this risk-on can carry on in the S&P 500, it means the dollar is going to continue to weaken into year end.
And you'd play that through the euro. Where does sterling fit in?
Well, we had short sterling Swiss on because we thought we needed some RV to hedge our sort of risk-on position. Sterling Swiss had been less correlated to the equity market than other crosses, but you can't ignore that Swissy is a risk-off hedge. So what's happened is we got stopped out of that short sterling Swiss, not because we had some amazing news out of the UK, but for two reasons. One, everybody agreed with the trade, and that always tells you that everyone's positioned the same way as you. And two, risk on. Sterling always does well when the equity markets rally. It's very rare that it doesn't. Only during Brexit really did we see that change in 2016. So for the likes of sterling, we think that you could climb towards 125 by the end of next year. And in these markets, guys, we're seeing big moves in dollar yen, for example, four big figures in just 24 hours. 125 is not that big of a push to see earlier if we have more good news. But based on what we know right now, it's going to be that slow grind higher.
It's hard for me to see any of this other than a big dollar story and everyone else is coming along and rationalizing it in some way or another. I mean, it was pretty much all of the major currency pairs were really big gainers in the past month versus the dollar. And are people getting ahead of themselves with this idea of fading inflation and a Fed that's going to somehow respond to that? I mean, could this really whipsaw in the other direction based on positioning?
I think it really could, Lisa, but not now. That's the problem with markets. We could have a view about what could happen in Q2 or Q3 next year. But the markets don't trade that just yet sometimes. And I think the risks are, for all my leading indicators for inflation in the US, they all point down. There's none of them pointing up. I can't really say, oh my God, watch out for this inflation risk. Look at this chart. They're all pointing to lower energy prices, lower inflation. Therefore, you can say CPI has peaked, and it's quite clearly peaked. We're looking for 0.3% on the core again, month on month. Nomura was the only team, the economics team in the US, to get that number right last month. So if they get that right again, and we have another 0.3 or even lower, it's kind of hard for the dollar to rally. But let's look to next year. We could have in Q2, China's reopened. Q3, we start to feel the impact of that in energy markets. And the Fed doesn't cut rates, perhaps. That's the risk. We think they will. But the risks are we have a wave of energy inflation again next year in Q3 as energy markets tighten up and demand comes back. And that could change the narrative quite a lot. So right here, right now, I don't think we're getting ahead of ourselves. I think the dollar can continue to weaken against the euro at least. And that should feed through to risk on in other G10 crosses.
Jordan, one reason why I love reading your reports is because you've got this confidence metric and you have, 3 out of 5, 5 out of 5. I remember back when you were 5 out of 5. Now you're 3 out of 5. How much are you seeing a lack of conviction or pulling back or humility in some of the positioning that you're seeing across FX as you sort of sort out all of these uncertainties that are lying ahead?
Well, I think there's a lot of uncertainty. What we tend to have in this market is prices moving, make narratives. Narratives then drive research pieces. But fundamentals ultimately drive where prices will be. Right now, the fundamentals are that we could perhaps see softer inflation, therefore weaker dollar. But we're getting to year end, and a lot of accounts were sat long dollar for most of this year, including ourselves since February pretty much of the year when Russia invaded Ukraine. Why wouldn't you be long the dollar? So that trade is still being unwound in certain sectors. And that means perhaps everything we're seeing right now is just position reduction and no one really changing their optimism for next year. For us, we think there's going to be recession risks. Usually when there's a recession, the dollar does well. The problem is we're starting to see signs of early rebounds in European PMIs, for example. China's credit impulse is going up. So there are fundamental reasons why you could see this risk on be sustained. You just need hope to prevail. And we do have risks coming up. We've got OPEC next week. We've got the EU oil sanctions on Monday as well. That's 21% of the EU's oil imports from Russia being sanctioned from Monday onwards. I'm not sure where they're going to get that 21% of their total oil imports from in the next month. So there are certainly risks to this outlook.
Jordan, you've got 20 seconds. What are you more confident about, your euro-dollar call or England getting past Senegal later this weekend?
I'm pretty confident about the England team. I mean, we've had the USA game was a bit boring. It was like watching paint dry. But what a fantastic Wales game. And hopefully they bring that back to the pitch.
Should Jack Grealish be playing more?
You're asking a Birmingham boy whether Jack Grealish should be playing more. I already know what Jordan's going to say. The answer is yes.
I'm happy with him playing every game, at least in the second half. He gets a showing. He got one of the goals as well in the first game of the World Cup. So this is fantastic for Birmingham. And it's not just Grealish now. We've got Jude Bellingham too.
Grealish is on the edge of Gareth. I mean, he gets in the field and things happen.
He's great.
Did I do okay
He's
there?
a really classy player.
I spent all night studying for this. With Jordan Rochester and you on World Cup. I mean,
we're breaking it down
all-nighters.
City to city, where these players come from, Tom. You're going to another level. Another level. Jordan Rochester in the mirror. Thank you.
I'm just doing it because of our love.
It's so deep.
You can't really afford to ignore the Fed's speak.
Certainly the Fed is still on this path to raise rates. They've made it clear they are not done.
We believe that they're going to hike and stay at those levels for an extended period of time.
They are going to keep rates tight, and that's going to keep pressure on earnings.
We're probably in for a period of below trend returns in the equity markets.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. It is December 1. It is time to buy the Christmas tree at the Keene house. Ferro out front on this as well. And the backdrop of November is a bull market no one saw coming. John, what happened yesterday?
Big gains for yesterday and the month of November, up by more than 5% in November. And Chairman Powell shifting the emphasis, Tom, I have to say. Moving away from this idea that there's asymmetric risk and the risk of doing too little is the greater risk than doing too much, and then yesterday all of a sudden he doesn't want to over-tighten.
We're going to truncate the 8 o'clock opening here at Global Wall Street. Well, good morning on radio and television. We got Mike Wilson coming up, an important conversation. Lisa, I'm looking at November and where we are, and I'm told always the bond market's out front of the stock market. Did that happen in November? Didn't
Yeah,
think?
Absolutely. Basically, yields down, and then that means stocks up. When does that break down? We keep asking that, but there is this feeling in markets that maybe we are seeing inflation roll over faster than they had previously expected. Neil Duddy yesterday, you talked about Neil. His base case was that it isn't rolling over as quickly and that people are going to get kind of blindsided by the reality early next year.
One more question, John, as we get to this. Are the bears capitulating? Do you see it within the literature? You follow this more heart-headed. Bank of America.
No. What's funny is that the bulls have capitulated. To see Marko Kolanovic of JP Morgan say we can retest the lows.
I think Mike Wilson got his first gray hair off that. You saw that Marko.
Well, I do wonder if Mike Wilson gets uncomfortable when JP Morgan starts to agree. But we could talk about that.
We'll talk about that in a moment. But it's fluid, folks, is what we're saying on December 1. We're making jokes about a Christmas tree, but what a year it's been, and we've got 30 days. And John, I'm gonna go to this to start the data check. I've got green on the screen. The Dow Jones Industrial Average. 12 months trailing is barely positive. No one saw that coming.
It's had a big move over the last couple of months.
SPX down 11%.
Equal weight S&P as well. It's had a massive rally off the low. Futures right now up by more than 1% on the S&P. Yields a little bit lower, Tom, by a basis point on a 10-year, 3.59 on a 10-year, and more dollar weakness. We saw it in November. The dollar, DXY down 5% last month and weaker again this morning.
Jordan Rochester, class act for talking about how you get out of those trades successfully. It's called a stop loss. He has been the big winner of the last 18 months. Michael Wilson, chief U.S. equity strategist at Morgan Stanley, was out front with a cute week-to-week talk about a bear market, and then up in June, down again, and now up again. An important conversation. John, why don't you lead off with Mr. Wilson?
Well, I think we've got to go to Mike's crystal ball. Mike, I think the call of the year wasn't the call at the start of the year. It was that tactical rally, that bullish call you made about a month or so ago. And Mike, we're seeing it play out. And I think we're all wondering whether you think there's much more upside from here.
Thanks, John. Good to see you guys. Hey, look, I mean, we talked about this the last time I was on, the tactical rally. I felt like the move to 4,000 was pretty much in the cards. And then we said, look, we don't know if we're going to get another level to this. If it's going to happen, we're going to need rates to come in further. And that's what's happening now. And it's going to be probably led by, the NASDAQ and also the, stocks that are most heavily shorted as rates come down the long duration plays. And that's exactly what we saw yesterday. And so we have more confidence that this rally will continue into December. It's not going to be easy. because I want to make it clear, as we said last time as well, it's still a bear market. These things are tricky, but we have to try and trade these. When you get 15, 20% moves that go against you, you don't want to miss it. And sometimes we get it right, sometimes we don't. This one we did. So we think it can extend here now. We think rates will go lower. We think, Powell's commentary is right in line with what we've been saying, which is that they're going to pause probably in January. And the market's getting in front of that. And this is a classic, kind of Fed pause stock market rally.
And then ultimately, you think we get beaten around the head with poor earnings as we go into 2023. Now, Mike, I'm going to read you a quote, and it reads as follows. Previous lows in equity markets are likely to be retested as there may be a significant decline in corporate earnings. We're inclined to think that this market decline could happen between now and the end of the first quarter of 2023. Now, if someone gave me that quote, Mike, I'd think it was you. Except it wasn't. It was JP Morgan's Marko Kolanovic yesterday. Now, Mike, you like to be contrarian. You have been through much of this year. I have to say that view now of early 23 earnings risk is almost consensus, Mike. How are you thinking about it as we go into a new year?
Yeah, I mean, look, you could say it for other people too. I mean, we all try to, stand out with something that's, insightful or different. And you're right. I mean, our call this year now has become pretty much consensus. But that's why we flipped in October, right, quite frankly, is we felt like that call, the fire and ice call, right, Fed tightening into a slowdown, became consensus. Now we see kind of this idea that we're going to make a lower low in the first quarter. I don't think that's quite consensus yet. But I tell you what's not consensus is this tactical rally. Okay, that we watched our competitors. We talked to a lot of clients to try and get a sense for where that sentiment is.
Right.
And I would say this is one of the most hated bear market rallies that I can recall, even more so than this summer. So I think the right setup now is this rally will go further and it will probably drag people back into thinking that the bear market is over. And then that will be part of the signal for us to kind of press on the other side again.
Pushing against that, perhaps, Mike, and this goes to Ellen Zentner and maybe Jobs Day tomorrow, is what inflation does, what the economy does. What do your analysts at Morgan Stanley say about the mystery of revenue growth at the top line next year? And if you get better revenue growth because of high nominal GDP, how does that redound upon margins?
Yeah, this has been an ongoing debate we've had with clients since really April. We were out in front on earnings disappointing at some point into 23. But that does contrast with this idea that we live in a nominal world. Nominal GDP is probably going to stay positive next year, even if we have a recession. Ellen's forecast next year is for not a recession, but basically 0% real growth. So it's going to feel like a recession. But to your point, if you get, if inflation is still positive, you can have positive revenue growth. We have that baked into our numbers, Tom. In other words, our base case of $195 next year assumes that we still have positive revenue growth of about 3% due to nominal GDP staying in positive territory. But it all comes down to margins. And this is the part of the story that we think is underappreciated by a lot of investors, which is, inflation is what drove profits higher. And so as inflation comes down next year, as we're forecasting, we have inflation going back towards 2 to 3% by the end of next year. That's actually bad for equities, good for bonds, but bad for equities because it's going to crush margins. And this is the story that we think is, once again, underappreciated. The negative operating leverage that we're seeing in business models as companies scramble for supply 6 to 8 months ago and overhire, that has to be, run through the income statement now. And that's going to be what makes the low in the first and second quarter. So I would say where people are maybe catching up on the earnings story, I don't think they're bearish enough in terms of this margin degradation.
Mike, you said that there perhaps could be a trough of 3,000 to 3,200 in the first quarter of next year as we do get that reality check from earnings. Have the recent data with respect to the latest CPI, with respect to some of the other metrics that people are seeing a softening in, and that we're hearing a change in tone from the rhetoric of Jay Powell perhaps yesterday, have you changed that view? Does that seem further away in terms of that bear case scenario?
Well, once again, I mean, the bear case scenario assumes we have probably a modest recession next year. And in that scenario, all that happens is revenue growth goes flat, maybe slightly negative, but that will make the negative operating leverage even worse. And so that's $180 in earnings next year. So with $180 in earnings next year, 3,000 is not really a stretch. So look, we don't have a crystal ball, unfortunately. I wish I did. In terms of what I'm most uncertain about is the timing of this. We thought it could have actually happened in the fourth quarter of this year, meaning these earnings revisions. And that's one of the reasons we flipped positive in October is we felt like it's going to be pushed out. And that's what's happening. Could it get pushed out further into the middle of next year? Yes. Do we think we can avoid it? No. So we think at a minimum we'll take out 3,500 sometime in the first half of next year. And yes, that bear case, unfortunately, is alive, and that's 3,000.
In the meantime, Mike, let's get one final call from you. What would you buy and hold right now going into year end? What would it be? And it could be away from the index. You tell me.
Yeah, well, I think it's bonds. I mean, I think that if you think about bear markets that are punctuated by either economic or earnings recession, we think we're going to get at least one of those, the earnings recession. The sort of order of operations is very clear. You want to buy you want to be cash first, then you want to buy treasuries, long duration, then you want to buy credit, then you want to buy equities last. So, we're already a lot of people are already overweight cash. So front end cash, or you own back end treasuries. Now, for a trade, okay, we think it's NASDAQ or long duration stocks will like that move in rates lower. But that's more speculative. That's for the trading community. I think for the investment community and for asset owners, it's basically bonds.
Mike, just phenomenal. Thanks for your time, and let's catch up before year end. Mike Wilson of Morgan Stanley. Mike, thank
with
you,
you
sir.
at 9 a.m. tomorrow, I thought.
Hopefully. I think maybe in a couple of weeks' time. There's a great piece. Shanani Bassett did a fantastic interview with Mike Wilson in Bloomberg Markets, this month's edition. So check that out. I think you can check that out online as well. Tom, just phenomenal. Just a great call from Mike and the team. And Mike would be the first to say this is a team effort, a massive team effort at Morgan Stanley.
That's the clinic there and the heritage. And I give Steve Roach all the credit in the world for this. They argue like no other firm. It is part of the culture. You have an opinion, you state it, and you're allowed to publish a different angle. That's the heritage of Morgan Stanley Economics, and it goes right over to their sell-side debate from decades ago, and of course the great work Mike Wilson's done, and that creates a fervor that you don't have at a lot of other firms.
Equity futures this morning elevated again. Just a little lift here, Tom.
Wilson moved the market.
Up 0.2%.
No question about that.
Equity futures
Marco
up.
didn't.
Yields down a little bit. Now. Down a basis point on a 10-year, 359.80 from New York City. With Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Chairman Powell behind us, in front of us. Payrolls data coming up tomorrow morning. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The missing billions from the collapse of FTX are still a mystery. The disgraced founder of the crypto exchange, Sam Bankman-Fried, denied he was behind a fraud. Still, he told the New York Times Deal Book Summit he made a lot of mistakes. It was his first major public appearance since FTX imploded on November 11th. 3 years since the world's first documented coronavirus patient in China, and the country is finally pivoting away from efforts to quash the pandemic. China's COVID czar says the fight has entered a new phase, and the government is making some concessions, such as allowing some low-risk patients to isolate at home instead of in controversial quarantine camps. Federal Reserve Chair Jerome Powell is signaling the central bank will back off its aggressive pace of raising interest rates this month. In a Wednesday speech, Powell also made the case for lowering inflation without sending the economy into a deep recession. Fed policymakers met for 2 days, starting December 13th. In South Africa, President Cyril Ramaphosa is considering resigning over an advisory panel's report that he may have violated the Constitution. Bloomberg's learned that Ramaphosa is in meetings with allies looking for advice. The controversy has to do with a robbery at the president's game farm. And one of the largest grocery chains in the U.S. has raised its earnings forecast for the full year. Kroger also posted third quarter sales and profit that beat estimates. Meanwhile, the company has put share buybacks on hold while it tries to complete a proposed $24.6 billion takeover of Albertsons. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
You used to be the head of the Fed, chairman of the Fed. What goes on in there? And you guys wear robes and sacrifice a goat, and then And right before the goat bursts into flames, it tells you the new interest rate hike that you're supposed to say. What is it? Why is it so secretive?
It was thought once upon a time, I can no longer remember why, but that monetary policy would be most effective if it was most secretive. And the truth is that the Fed never even announced to the public what decision they had made about monetary policy.
The Treasury Secretary and former Fed Chair Janet Yellen sitting down with Stephen Colbert on CBS here in America, Tom. I understand she's also been practicing her signature, ready to sign the currency, and does not want to make this mistake that a certain Jack Lew. Do you remember Jack Lew's signature, Tom, on the currency? Do you remember those squiggles? Those round things, whatever they were?
15 zeros.
Was it 15 zeros?
Something like that. She was like, it could be destroyed.
We got to call Mr. Colbert up. I think on the Fed show he's a value add for
He's going to bring the rate call. How many goats did they sacrifice before voting for 50 instead of 75?
Maybe those are the questions we should ask.
Maybe.
There as well. What we're going to do right now is we are going to turn to what Nick Fandos over in the New York Times and our wonderful Greg Giroux have looked at is the seismic tilt of Republican success, and that success came in New York. Maybe it was on Long Island, maybe it was above New York City, but the foundation of Republican success for so much of New York starts and ends on Staten Island. Nicole Maliotakis breathes Staten Island. She is one of those rare things, a Greek-Cuba immigrant from a long time ago, her parents, I should say, in the time of Fidel Castro, and she joins us this morning. Nicole, very simple. Thank you so much for joining Bloomberg Surveillance. You guys won on crime. You guys won on a select other issues, a fury of scared suburban voters. What now? What's the next after your victory?
Well, look, we need to continue to push for the policies that we talked about during the election. I'm not going to stop calling on Governor Kathy Hochul to fix the disastrous bail law that has led to crime skyrocketing in New York. I'm not going to stop speaking out against her congestion pricing plan that will just add to the burden of driving into Manhattan for, whether it's employees or visitors or tourists, and I think that would have a detrimental impact to the city of New York. And I'm also going to push for what I said I was going to do, which is to stop the inflationary spending, to focus on securing our border. And that's really what my constituents want, and I think that's what the vast majority of Americans want. I heard them loud and clear when I was at the supermarkets, when I was meeting with them at the senior center or speaking with our veterans. And now we're going to try to push for that now that we have the House of Representatives on the federal level.
Do you sense that this is a polarized constituency of the greater state of New York and frankly of the nation? Or can you find common ground forward with what I'm going to collegially call disaffected Democrats?
Look, I'm a member of the Problem Solvers Caucus here in Congress, where we do try to find some common ground on solutions. I think one of the top things where we should be able to find common ground, quite frankly, within the moderates is energy policy. Look, I'm for clean energy, right? But I'm for diversification, just not to the exclusion of traditional energy sources that we so depend on for manufacturing, for transportation of goods, for food. And that has to be really what we need to do, is unleash America's potential in all aspects. So I think that's one of the ways that we can actually address some of the issues that we're facing with inflationary costs, particularly with energy, and bring down costs for consumers and on manufacturers and small businesses. I think that's one area. I think on border security, this should be common sense. I mean, people should want to see our nation's borders secure in a post-9/11 world. The fact that you have over 100 terrorists who have crossed and tens of thousands of convicted criminals, they should want to address that and the fentanyl that is streaming over, killing Americans.
Congresswoman, a lot of people are questioning the leadership right now of the Republican Party, especially as we start gearing up for the 2024 election run-up. You've expressed support for Donald Trump. Do you continue to support him as the leader of the Republican Party?
Well, look, I don't know if he is the leader, but he certainly is a leader of the party. But I think what's nice about the Republican Party is we actually have a bench for once, right? It's not, just President Donald Trump. We have people like Governor Ron DeSantis. We have other leaders like Nikki Haley and Mike Pompeo. We have leaders that are coming into the House of Representatives that are very reflective of America. We've just elected more African Americans, more Asian Americans, more Hispanic Americans, and more women. So we have a bench right now. And the bottom line is we're going to find the best candidate to run in 2024. And I think it is important that we are united in this process. And look, it's just playing out now. We just finished with the midterms. But we must be united going forward, both as a conference here in the House, so we can push President Biden on the border, on public safety issues, on energy policy and inflation. And that's what we're focused on right now.
Is it important for the Republicans to be united, or there to be a united, sort of more centrist look at how to make policy? And I ask that because a lot of people took the takeaway from the latest election as a move to the center.
Mm-hmm. Sure. Look, I think we just have to find that common ground of where the Republicans in our Big Tent party can come together to support the candidate that we think will be able to have the best chance of winning in 2024. But make no mistake about it, if you compare President Trump's economic policies and border security policies and energy policies with that of President Biden, you want to throw in foreign policy as well with the success of Abraham Accords and USMCA, I would say that we were much better off as a nation in terms of policy under President Trump. And so I think we want someone who's going to continue to push for those same policies, whether it be him or somebody else. But I think the bottom line is we needed a balance in Washington, and we were able to achieve that this cycle by getting Republicans. One-party rule has been disastrous for, I think, the country and also for my city and state. So we're just looking forward to, yes, find common ground. I'm willing to work with the Democrats when we can come up with sound policy that's going to address these issues that I mentioned: border security, energy independence, stop the inflationary spending, and let's protect our men and women who serve our nation, both whether it's at the border or in our cities.
Congresswoman, thanks for your time today. We appreciate it. Down in Washington, Nicole Maliotakis there. Weighing in on some of the big issues. I want to keep it on foreign policy just briefly, Tom. Just hearing from the French President Emmanuel Macron speaking to ABC ahead of this big get-together over the next couple of days with the President of the United States. He's saying the Inflation Reduction Act lacks a level playing field, that the so-called IRA has not been properly coordinated with Europe. And Tom, this is something we've been talking about over the last several weeks. There's just a little bit of growing tension here between the Europeans and this administration over this issue.
And you see it on Brexit as well, where it was going to be a Pax Britannica, and they were going to expand out as well. They're running into trade realities, and you see how that goes forward. And one thing I would say, John, is into next year, we have to redefine post-pandemic what the new globalization is and what the new transatlantic is.
Can't avoid this story either, Tom. Macron says that Musk ending moderation on Twitter is, quote, a big issue. For the Europeans, and I guess that content moderation might become a bigger issue for the Europeans, then, Tom, we're going to have this conversation about whether Twitter will be taken down in Europe, and this will go on and on.
And can he talk about, like, what it costs to fly to Paris? Can we, like...
You want to have that conversation with Macron?
Give us more flights.
Cheaper seats from New York. This is Bloomberg. Seconds away from economic data in America, teeing us up for payrolls coming tomorrow morning. Going into all of that, equity futures at the moment on the S&P 500 through most of this morning, kind of positive or negative by a couple of tenths of 1%. It stays that way this morning. The S&P up 0.2%. That economic data dropping right now. Let's get to Mike McKee for more. Hey, Mike.
Good morning, John. Well, we've got some numbers on initial jobless claims. They're the first ones to fall here, 225,000. They're staying in the same range. It's kind of interesting, and I'll discuss this a little bit more with you on your show later. But Goldman Sachs is suggesting that these are artificially high, that the seasonal adjustment practices adopted by the Labor Department after the pandemic to account for the wide dispersion at that time are pushing up the jobless claims numbers more than they might otherwise be. But this is a big drop, 225, 240, so whether they're distorted or not, it's still good news. Now, the big news of the day, the income and spending numbers, and I'm going to go straight to the inflation part of this, the PCE. Mm-hmm. This is what the Fed follows, up 0.3 during the month. That's less than the 0.4 that had been anticipated by economists surveyed by Bloomberg, puts the PCE deflator for the year at 6%, down from 6% 6.3% the prior month. The core, which is what everybody's focused on, 0.2 lower than the 0.3 that had been anticipated. And the core for the year is now at 5%. That's down from 5.2%. So the numbers that the Fed follows on inflation are better than anticipated. Income's up 0.7, and I'll look in just a second to see where that money's coming from. Spending up 0.8, and both of those are significantly up from the month before. So at the same time as the economy is strong, inflation coming down a little bit. Now those income numbers may be affected by the inflation numbers. Real personal spending, inflation adjusted, up 0.5. It was 0.3 last month. So Americans are still spending money, but inflation has come down a little bit.
Upside surprises where you want them and downside surprises where you might want them this morning. If you're long this equity market, we have a little kick car here on the S&P, Tom, up by about 0.4% on the S&P 500, a little leg lower on Treasury yields, particularly on the 10-year and beyond. The 10-year down by about 3 basis points to 358 this morning, TK.
We're going to get to Reinhardt here in a moment, but I've got to ask you, Mike, about this. I mean, after what we heard from Powell yesterday, this is really not what he wants, and particularly if we get more accommodative off the Bloomberg Financial Conditions Index.
I guess you could make the other argument, Tom, that it is what the Fed wants because they don't want a recession. And if we're going to see some strength in spending, that's going to be okay in the long run. The question is, does it push up inflation? And if inflation's coming down at the same time that these things are going up, and we'll have to dig into these numbers, that's going to matter. So, for Jay Powell.
We got to get to Vince, but very quickly here, Liz Ann Saunders out making a big deal about the Challenger numbers. You and I have looked at Challengers over the year and said, maybe it's not there. Is Challenger like ADP, where I don't care, or do you see the Challenger job statistics as a concern?
Challenger is
gray. Challenger gray.
You don't care because they compile from press releases job cut announcements, but those are overseas and in the U.S.
Okay.
And Challenger exists to make the ADP look good.
It's attrition.
I'm just bringing it up because
firing.
They're the numbers. They're pretty grim, and that's what we do, folks. We talk to adults like Mike McKee and Vince Reinhardt.
More numbers in about an hour and 27 minutes. Looking forward to getting the ISM a little bit later. Mike McKee's going to break that down, Tom.
The quality of what we do as we celebrate Lisa Abramowicz, John Ferro, and I in Bloomberg Surveillance, what we do every day is our guests, and it starts and ends with the research capabilities of Vincent Reinhardt, assisting chairman Greenspan over many, many years at the Fed and at Dreyfus Mellon, holding court in important writings in the pandemic about the state of our economy. Vince Reinhardt, just a general question of a 2-hour conversation. Do you buy the idea we're heading for recession? In your years with Greenspan, were you able to predict a recession?
Nobody really predicts a recession. What you can say is there's an elevated chance of it, just like you could say you have an elevated chance of infection if you go into bad places without a mask. There is an extremely elevated chance of recession. And if you had to place your money, I bet that within 12 months, the economy's in downturn.
I look at this, Vince, and then I look at the parlor game of the Fed, which is now different than when you were holding court at the Eccles building. And the basic idea here is we're gaming out a rate movement higher, and then we are, quote unquote, going to figure out to pivot and guess when that occurs. Have you ever seen anything like this, or is this new pundit territory?
No. This is old-style monetary policy. Right now, monetary policy is hard but simple. It's hard in the sense they have to inflict pain on the economy to get inflation down. It's simple because the strategy is if you don't know what the right neutral funds rate is, put it at a level you sure is restrictive and then keep it there until you have demonstrable evidence that inflation is going back to goal. So if you're not exactly sure how to calibrate policy, don't. Put it at a plateau next year and just wait. That's what Chair Powell told us yesterday.
Is that what he told us yesterday, Vince? Or did you hear perhaps a little bit more of a concession around perhaps moderating their stance in order to avoid a hard landing?
I don't get how most of the headlines came out of that remark remarks yesterday afternoon. He repeated his press conference characterization. We're raising rates till we get them to a level, and then we're going to keep them there. He dismissed a lot of data. With regard, I don't want to be on the other side of Mike's argument, but I think I have to be. Yesterday, Chair Powell said inflation moves around. Sometimes after good numbers, bad numbers come out. So I think that they would downweight the PCE price part of this. And then what he was saying was we've got to keep the pace of aggregate demand below that of trend. So he should be worried about the spending part about it. This was not a good morning for the Fed.
Well, Vincent, this is really the key point. A lot of people are saying that there is a downward shift in inflation, and it's coming at a pace that's surprising analysts, that this is good news. It's going to allow the Fed to move away from some of the rate hikes and even cut rates sooner than previously expected. Do you think people are getting ahead of themselves, that really those inputs are not declining quickly enough, and that they could even re-accelerate based on some of the rollover effects in areas, for example, like used cars?
Events always look bigger in the rearview mirror than they really are. I think there is a tendency to overweight this incoming information. Chair Powell said that yesterday, by the way. He said inflation's volatile. Sometimes after good readings, you get bad readings. He was basically telling us not to be so stressed about it. Do I believe inflation is off its peak? Absolutely. Goods price inflation has come off the boil because supply chains have been improving, and market economies work by bringing resources into sectors that are overheated. But it's spilled over to service inflation. That's what you got to worry about. That's what Powell's worried about. The durable part of inflation that's still above the Fed's goal.
Vincent Reinhart, Olivier Blanchard reaffirmed a higher level of inflation we can be comfortable with. He went from 4% in the crisis of 08-09 down to something more like a 3% level is the new 2%. Without going into the details of the Blanchard essay in the FT, is he onto something here, which we are going to rationalize our way away from the 2% level?
So yes and no. The yes part is back in the mid-90s when central banks settled on a 2% inflation goal, it's not like they had a great conversation about the costs and benefits of that long-term goal. And we know more about problems with the zero lower bound. And so we should have a serious discussion of what the right goal is. In the United States, it's got to include the Congress, by the way, because it's the Congress that specifies price stability. That's my no part. I wouldn't want to have a conversation with the Congress about the Federal Reserve's goals most times, certainly not in the next 2 years. Moreover, it's one thing to redefine the goal when you're succeeding. It's another thing to redefine the goal when you're failing.
We call that the Bank of England.
Yeah, that's just base drift. That you just can't do it.
Hey, Vince, well said. Vincent Reinhart.
That was brilliant.
Wonderful, thank you.
Brilliant.
Of Dreyfus Mellon there. And Vince is right. If you can't get down to 2 and you start talking about 3, Tom, I think you can make the argument it would be equally as difficult to get down to 3 because people have started to question the commitment to that.
Oh, that was just brilliant. I mean, Vince is very dry and academic and that. But you look, John,
he'd appreciate that characterization.
No, I mean it. I mean, with this heritage of research on serious stuff on economics.
Our last guest was so dry and academic.
I think he's fabulous.
When he was in research at the Fed, they were on fire. They were writing really wonderful reports. But we've got the idea of the work we've done on surveillance with Blanchard over the years, Adam Posen at Peterson Institute, on to Vince Reinhart. And then there's Jean Boivin writing yesterday in the FT, and you've got him in the 9 o'clock. I mean, that's
Great
what we're doing here.
Next hour.
I mean,
John
I'm
Boivin
sorry. That's what we're
of
doing.
BlackRock, Seema Shah of Principal. Going to catch up with Chris Harvey of Wells Fargo as well around the opening bell. Mike Wilson was on about 40 minutes ago. If you missed that, this call he had over a month or so ago about this tactical rally you could get, this bear market rally into year end. Well, it continues this morning, Tom, up 0.5% on the S&P 500. The consensus view is that we get smacked around the head by the reality of bad earnings in early 2023. But at the moment, Tom, this equity market keeps climbing.
Yeah, it's just extraordinary all in all. And, I look at the heritage of what we've got in the equity market climate and that. This reminds me of when Tunisia, they beat France yesterday.
What a game.
When they beat North Macedonia, that was really something.
You had to do that on our anniversary.
I had to do that with the exit out
on our
here.
anniversary. Where's the love?
There's
taking,
no love.
Taking digs at the Italian football team?
No, I just think that Tunisia, North Macedonia was probably a more competitive
Are we going to do this another 10 years?
They won on penalty shots.
Do you reckon we can go another decade?
I think so. Lisa, what do you think?
I don't know if Bramo could handle us for that long.
I'm just waiting for you guys to work it all out.
I don't know.
No.
You let me know how therapy goes.
Thank you for the comments, folks.
Future's positive, 0.5%. Happy anniversary.
Oh, please go away.
I will.
Go away.
To my next show. This is Bloomberg.
Steal our guests.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Federal Reserve is set to slow the pace of raising interest rates this month. In his speech on Wednesday, Fed Chair Jerome Powell signaled the unprecedented run of 475 basis point hikes could come to an end at December's policymakers meeting. He also made a case for achieving lower inflation without sending the country into a deep recession. It's now up to the Senate to avert a crippling U.S. freight rail strike. The House has passed legislation that would impose a labor agreement hammered out by rail companies, unions, and the Biden administration. 4 of 12 unions have rejected that deal. The Senate could vote on the House legislation this week. Meanwhile, the UK will be affected by strikes every day this month in the run-up to Christmas. Workers from the country's rail network, buses, postal services, health sector, and schools are among those staging walkouts. Union leaders want to cause maximum disruption in their bid for higher wages. They're concerned about inflation and the government spending cuts. One of the European Union's top officials has warned Elon Musk to keep Russian propaganda off Twitter. EC Vice President Yera Yourova told Bloomberg that failing to take on fake or misleading content online could lead to very quick abuse of Twitter. It's the latest warning shot over the possible side effects of mass resignations and layoffs at Twitter. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Markets are pricing rate cuts, a pretty aggressive rate cut cycle. But in the face of this persistent inflation and supply constraint that I just talked about, we believe that they're going to hike and stay at those levels for an extended period of time.
An incredibly important conversation yesterday, and Bloomberg Surveillance stopped with Wei Li, chief investment strategist at BlackRock. Her comments on her China, Lisa, were stunning yesterday.
Especially,
it was like a pin drop in the room, and it's never like that.
Especially at a moment of such incredible calibration, and so many people are getting bullish right now in China going into next year on the prospect of reopening. How do you parse that out? Taking a different view there.
Just thank you to Wei Li for those comments. Just really, really important. Somebody that was there when Mao took over China was Robert Dahl. He's chief investment officer at Crossmark. He's been doing this a few years along with me, and we're thrilled he joins us in the studio this morning. You got a little bit in your note there. For the first time in 50 years, we've been this gloomy. We've had this much gloom out there. And that's why I make the joke back to 1947. But part of that is years in my history is when inflation moves, it moves suddenly to disinflation. Is that where we are right now?
I don't think we're quite there yet, Tom, unless you're going to call acceptable or disinflation 3 or 4%. I think we can get there with what we've done, but not 2, nowhere close to 2.
Okay, well, not to 2, but then we're there, and that means I've got nominal GDP, which helps corporate revenues.
Yes.
Who are the survivors of a better corporate revenue, given an inflation milieu that you and I are the only 2 that have ever lived in?
Given that we want some pricing power, you've got to go to the places where people can raise prices. We haven't been in that environment in a long, long time.
And I'm going to tell Lisa, you're going to love this. I used to go up and down the elevator in Boston with the giant Philip Carre, who Bob and I worshiped, died at, I think, 104. And Mr. Carre would, and it is Mr. Carre would talk about the bright lights of inflation. That's where we are now.
So if we're going to talk history, let's talk history. And let's talk a half a century ago, which was the last time that we saw 3 consecutive quarters of stocks and bonds losing value together. What does history say? And is it instructive in terms of what that means going forward?
Well, first of all, the reason it happened was the rapid adjustment. We had essentially zero inflation and zero interest rates, not to exaggerate by much. Then all of a sudden the Fed said, oh, it's not transitory, and we got to get moving. And so we've had the most rapid increase in Fed funds. And you guys said it a few minutes ago. The lag is impossible to predict about the impact of that. And so we're going to have a slowing economy, and that will help bring the inflation rate down. The Fed's got to pray that the labor market quiets down.
So one guest after another has talked about flooding into treasuries, flooding into duration. Even Mike Wilson of Morgan Stanley, he comes out, what would you be buying? The equity strategist, bonds, right? I mean, how much do you lean into that versus step away and say maybe people are overestimating how much inflation can drop?
I think, Lisa, that owning some bonds is just fine. It's zero at the beginning of the year. You didn't want any. When treasuries approach 4 on the 10-year, we say you got to be nibbling away at bonds, and we're not that far from that now. So, the old 60-40 is dead that we all preached a year ago. Not true anymore. Bonds have a place in the portfolio, especially if you believe inflation's coming down to 3 or 4. Forget the 2 for the moment.
My theme for next year, you're the only one breathing who remembers a specially chemical roll-up of years ago. Remember?
He's not that old. Like, what is this?
Thank you,
But carry on.
No,
I mean, come on.
Bob and I remember when every wise guy in Manhattan said we got to roll up the chemical industry. Remember that?
Yes.
We all went mental for 18 months and turned it into 3 companies or whatever. I'm talking about the great zombie roll-up next year where we demarcate between profit-making and cash flow making companies and everybody else. Do you agree with that there's going to be a demarcation?
So agree. And what that means more broadly is fundamentals matter again. When interest rates are 0, they're artificially low, and you can't really say that the good guy wins from a stock price standpoint. How did Sears last so long? The answer is because they were given artificially low interest rates, and that was tough for places like Target. Now, in this environment, the Targets will do well, and the Searses will struggle.
Explain to people that under duress, corporations adjust. How does that process actually happen?
Yeah, it's slow because they've been so used to zero inflation and
They had a free lunch for 12 years.
Exactly, and got used to operating in that sort of environment. This is a different world now. And we come back to, can you raise your price? Can you attract customers and keep them as your price rises? Look at what's happening in the steel stocks, for example. You mentioned chemicals earlier, but the steel are poking their head up. And this is telling us we're in an environment where inflation's not going back to 0. I don't think it's going to.
U.S. steel is still X. I haven't looked at that in years,
See
Lisa.
that chart?
But people are talking about how the real economy is getting its revenge. That has been the theme for 2022, and it's rearing its head, and that's why you're seeing the inflation underpinning some of these commodity sectors. How much does that mean that the other areas that got bid up, I'm thinking big tech in particular, can't really come back in the same kind of way and won't necessarily drive indexes to the same extent?
I think you're onto it. We've obviously seen it this past year, but I think going forward, we're going to have the same sort of issues. If you're a company that's operating only on unit growth, your unit growth's got to be really strong to get you through. And tech is mostly unit growth. So I think they will be a lagging sector again.
What are your clients doing? Well, your Crossmark out of Houston and, nationwide and all that. Are they loaded up their eyeballs in cash? What are they actually doing with their money?
Yeah, so people are asking a lot of questions. Too many people are frozen. But they're making investments. You have to hold their hand and draw them to the horse to the water and help them drink.
Sing, "Let It Go."
Yeah, something like that. Something like that. But they're doing something. They're doing more. Get educated and buying some alternatives. Like we have an equity market neutral product that's getting some attention.
You're selling now.
Yes.
You have an equity market neutral product.
Yes.
Bob Dahl, the great optimist. Thank you so much with Crossmark.
All the best.
Global
Thank you.
Investments here. And Lisa, we've got some optimism. I don't want to oversell the tape here right now, but off the economic data that gets us to jobs tomorrow, McKee lectured me, forget about year over year, Tom, we're moving too fast. You go month over month, and those statistics on PCE deflator are actually pretty good.
Yeah, I don't buy it. I'm going to be honest. I don't buy it. And this is the reason why, because you saw an upside revision to some of the data. So it came down less than expected, but it came to the same levels that people were previously expecting. Yep. Right now, you're seeing confirmation bias in markets pretty much uniformly. People are taking this rally and running with it. I keep wondering whether anyone's actually pulling back from the pessimism that starts next year, or they're basically just trying to get ahead of it. But this is a timing issue. It's not that people think that the clouds have all abated.
To be fair to you, I'm hearing that as people rationalize this bull market, including what we heard from Mr. Wilson of Morgan Stanley, is that everybody's doing timing. Everybody's trying to figure out, we're going to go up this and then we're going to go down and we're like this. And I don't hear anybody like Bob Dahl saying, would you just buy amalgamated copper and hold it? Well, I don't hear that.
A lot of people actually are talking about the commodity sector because it has been underinvested and because of some of these, secular trends that are going to boost them. Again, China reopening, colder winter, recession.
What's great about it is on this anniversary of Bloomberg surveillance and all that, Lisa Abramowicz, John Ferro, and Tom Keene, we end strong with Bob Dahl, who actually knows what the Dow Jones Industrial average.
It's not fair. John isn't here to rebut that. Discuss equal wage.
Thank you for your comments today. Rumor has it we'll be here tomorrow.